Hey, good morning, everybody. Good morning, buenos dias, and all those things. Happy Monday. Man, Lyle, I totally get a little frustration with that. It's hard to type and come across the way you're trying to come across. Um, it's interesting that you have to keep going when they have the 1 day thing, because they did have that going. Um, where you could literally just qualify within the 7 days anytime and you were good. But I have known people that have qualified and then tried to trade live and blown out the account. Um, it may be me that did that once, even when you shouldn't take chances and you're like, I'm so good, I can do whatever I want. Um, I get it. Good day to go swing some golf clubs or walk on the beach or whatever it is that you do. Just once. No, I literally, Ron, I'm not proud of this. I had qualified an account, but I had to trade for another 3 days, and I thought, well, I'll just trade live, right? I got here anyway, and yeah, and I ended up messing it up. I ended up having one of those emotional unhinged days, and I actually had an account qualified 3 days short and blew it out before qualification. Um, and I'm not really proud of that, and maybe I shouldn't share that in the room, but man, some days you just have a bad day, and And that's where rules come into play so much, guys. That's where rules are so important. Understanding what they are, understanding when you're following them, and then more importantly, understanding when you're not following them and just saying to yourself, man, it's not working out, you know? Maybe I'm doing something. Yeah, Lyle, without a doubt. Without a doubt. Two types of people, the people that have done it and the people that lie about having not done it. So Um, it's just a part of trading, guys. It really is. I enjoy it though. I like it. Trading's like golf, guys. The less you try to force it, the easier. Um, yeah, the easier it becomes. The less you try to force it. You're welcome, Adriana. Nobody likes to admit they're human, right? When um when you're 15, you pretend like nothing that's happening to your friends has ever happened to you, and that never really stops in life, I think. Bob posting a picture for me. I like it. But before we get to pictures, guys, let's get into the routines. I wanted to get to 9 o'clock, just make sure everybody that wanted to be here was here. Um, I start off at forexfactory.com every morning. And even on the days when there aren't news, I come in and I remind you guys that checking your news every morning creates a really big advantage. And especially if you're on one of those Apex accounts, they won't let you trade in the news. They say it's too erratic, too emotional. Don't do it. That's what Apex tells you. They're like, we're not going to pay you if you have a big lucky trade in news. And guys, they do that because there's emotional responses every time that there is a high impact or a medium impact. Today is Monday, March 11th, and there is no news, which is cool. We're just going to trade away today. Look for our rules to be met. But you'll notice tomorrow there's a lot of red boxes at 8:30 a.m. For most people, this is just saying, hey, let's sit on our hands for a minute at 8:25. Let's wait for somebody to react to the market. And then once it smooths out, we'll get going again. So I check this every morning, guys. I also make sure that I go to the education page, guys. This is where everything, I mean, literally everything that you need shows up. The software user guide is your NinjaTrader how-to. Sharing pictures in class, opening, closing workspaces, adding templates, scaling your charts, right? Have you ever had that moment where you just can't see your chart anymore and you're like, my software's broken? There's a whole thing on scaling, getting that stuff back, setting up stops and targets. What else is in there? Changing the trigger lines if you don't like the looks of them, deleting old charts, resetting your simulator, adding symbols, rolling contracts. Guys, NinjaTrader 8 rolls automatically for you. They send you a message. Each and every one of you, when you opened up NinjaTrader today, should have gotten that message that says, hey, we're going to the June contract. So my Russell will be on the June contract. My NASDAQ will be on the June contract. If we look at the S&P today, it will be on the June contract, no longer the March contract. That's where the volume is now. Crude oil does not change today. The indexes change differently than the crude oil. So, guys, all of your Ninja Trader how-to is in here. And then, of course, if you're in the room and you have a question, just ask. You don't have to go look it up. All you have to do is go, hey, Mark, how do I do this? And I'll talk you through it. I will give you a fish to make sure you don't starve, but I'll also teach you to fish so that if I'm not around, you can take care of it. The next is the tutorial section. I went to the tutorial section here, and this is where everything that I talk about is. And I mean everything that I talk about comes right from this section. You're not gonna need to go search someplace else. You're not gonna have to buy extra information to be proficient with the software. Anything and everything that you need, I'm gonna give you. And we're gonna go to the glossary of common terms. This is a great once-over for my newer users. I know that I've got a couple new people in the room. Go through and just get some of the language down if you have a question, if you need something. Gary's showing you guys the volume that I just talked about. The new contracts have more volume, so we will be on the new contracts. Thank you, Gary. But the one thing that I want to point out, coming from this glossary of common terms, guys, is this right here. This is the high probability trade. For those of you that don't know me, I was an English Lit major. I do put a lot of value in words and what you say and how you say it and where you say it. And the high probability trend trade is defined when each indicator on every chart agrees for the rules for the trade. Typically, this is when all triggers are their strongest, no termination conditions exist. There's no trouble spots between you and your entry point, guys, or your target. This is the best of the best. This is the one that just creates confidence through the memory of success. We're going to talk about this high probability scenario in terms of a trend trade. We are going to focus on the rules extensively. We're going to make sure that you guys understand how to recognize advantages. And the high probability trend trade, guys, should just be your foundation trade. Give it 20 days focused on this absolute best of the best. Give yourself 20 days just learning how to read your charts, because that's what the high probability trend trade does for you, is it turns you into a chart reader. And that's going to be my transition over to the slideshow here. Good morning, Miss Cindy. Happy Monday. Chart reading, guys, is going to be the first skill that you really focus on with Nexgen. Most people are like, well, I want to learn how to get rich. I want to learn how to make money. I want to learn how to be successful. Guys, the easiest way to do that is learn how to read your charts, because chart reading is literally 90% of your day. It is 90% sitting there looking, hey, good morning, Dwight, looking at your indicators, gauging advantages, and then finally deciding to take a trade. So if you're in a 6-hour day, you're going to spend, 5 hours looking at your charts waiting for advantages. You'll spend an hour, probably less, actually pulling the trigger and getting in. But once you're a chart reader, and that's what the high probability trend trade teaches you, is you're going to understand 3 very key concepts, guys. You're going to understand where the market is likely to continue. And this becomes your entry point. This is getting you in, buying low, selling high, the absolute best of the best. You're going to understand where the market is likely to go. This is going to allow you to make great decisions on taking profits, exiting your positions. And then finally, you're going to understand where the market is likely to stop. And we call these here at Nexgen termination conditions. And termination conditions are just that. They're where the market may terminate, where it may stop, where it may reverse. You're going to be able to identify these areas, and you're going to understand that the people that move the market, the people that are in control, that they're going to react to these likely to stop areas, these termination conditions. And the cool thing about doing what we do is you don't ever have to get caught in the fights by the people that are in charge, because you know where they're going to fight long before they ever get there. So you will understand where it's likely to continue, where it's likely to go, where it's likely to stop. But we're going to focus first on trade entry precision. We're going to focus on the high probability trend trade. And we're going to do it so that you can get into the market where it's most likely to continue. And then from entry, we're going to give you a simple plan for management. I don't know why I'm saying we, it's just me here. We're going to give you that simple plan for management, allowing you to get paid from the best entries more often than not. So your path to becoming a confident trader ASAP, guys, it begins with posting pictures in the room. Every time you do something, post a picture. So Bob, you didn't know that this was going to happen, but I'm going to use you as an example here. So Bob posted in the room, and Bob said, hey, Mark, check it out. The triggers are strong. Clear path after the area was clear. Took a pull back to the large triggers at an area, took a one lot and got paid. Amen. So what Bob did is said, hey, Mark, am I looking at this right? I had one of those likely to stop areas and it reversed the market. And I'm like, yeah, that's great. And then rule number one, I'm not sure what POS means. In my circle, it means something probably completely different. But positive triggers, Bob? And this is one of the things too, guys, when you annotate your charts, I'll learn your language. But this is what we call strong triggers, guys. This is a market that's likely to continue in the direction of the trend. And then when you have that, what you can do is you can gauge where the market's likely to go based on that momentum. And then we just find a little entry, typically in an area right inside of triggers. And Bob, you did this beautifully. You took advantage of a termination condition that created a reversal. You waited for the market to provide you the best look ever in momentum. You made sure that you hadn't hit that fib down there, and then you just capitalized going down. And that's a beautiful trade. So the cool thing is if Bob had posted the picture in the room, let me pull this back up, and Bob's picture didn't have maybe momentum, or maybe Bob's picture had already reached a termination condition, well, then we could have a chat and we could say, hey, Bob, guess what, man? That was the best looking momentum ever. But I want you to notice how price got to this line and nothing really cleared it yet. This lets you know that this bounce may happen. And then Bob and I have this awesome conversation. And his next trade, he goes, man, I got to look out for those termination conditions. And that's really all the class is. It's you guys presenting and me offering feedback. And together we go back and forth until you just get to where you want to be. We try to take a mistake out. We try to enhance a positive, celebrate a victory until you guys are just comfortable reading your charts. So post your trades in class, guys. I want you to post them if you win. I really want you to post them if you lose. If you've been struggling a little bit, I want you to post in the room. If you are finding yourself a little disheveled and unfocused, post in the room. Let's look at what you're doing. And then the second thing is using your spreadsheet. Nexgen provides you a spreadsheet, guys. I'll give you mine in the room right now because I certainly don't mind sharing. But the spreadsheet is 3 tabs. Your first tab is your trade tracking sheet. Your first tab is where every time you take a trade, you're going to drop it into this sheet. And the key to success with the spreadsheet is don't just take a picture and drop it in and then never look at it again. Every morning, pour a cup of coffee, maybe a little hot tea, and study the previous day's trades and really ask yourself what worked and what didn't work and what felt easy and what felt forced. And what you'll find is that there's a direct correlation between what works and feels easy with the 3 advantages that we're about to talk about. And there's a direct correlation between what doesn't work and what feels forced when you find yourself trading outside of your rules. So this brief historical study each and every morning, it will not only prepare you for the day, hey, good morning, Miss Debbie, but it's going to accelerate the learning process. It's really going to get you where you want to be faster. I always say you're going to get out of the software what you put into it. The more time, the more study, the more feedback that you receive, the quicker you're going to get to where you want to be. So you have to kind of make the decision, do I want to get there quickly? Or do I want to spin my wheels a little bit? Do I want to do it my way? 27 years Nexgen's been teaching people how to trade the markets, how to read the software. We've got a pretty good plan in place. Your second tab, this is your favorite trade setups. This is your personal trade setups. This is where you're going to build your trading plan. So every time you take a picture, so for example, Bob drops this gem in the room and he's like, whoa, This is exactly what I want to do every day. I want to trade from termination conditions. I want that much momentum. I need that path clear. He's like, you know what? I'm going to take this picture and I'm going to go to my personal trade setups and I'm going to paste that picture link in there because I need to come back and study this tomorrow morning. I need to make sure that I can do the same thing over and over because of the advantages that it provides. You'll notice that it's that screencast link, guys. I'm going to give you a little trick to cleaning up your spreadsheet. If you go to your Insert tab and click on the link button, what this does is it turns that address into a hyperlink. So paste the address one more time in the Address tab, just like you go into Google or eBay or Golf Now, whatever. And under Text to Display, I don't know, put beauty of a short, whatever makes you feel like, yeah, that's what I want to do. Click OK, and now it's there forever. So Bob's going to come back tomorrow morning, and he's going to see this in his personal trade setups, but more importantly, he's going to come over here, and he's going to say, I've got to remember to put this trade into my trade journal. We'll call it Great Job. And then once you're in the trade journal, it's going to ask you, how'd you feel? Bob was like, I felt confident. I had every advantage in place. And I was coming from a strong top. And my 13-2 triggers were strong, strong, strong. And my 5-1 was just freaking magical. And I won. And that's all I did. I'm a winning machine. And when I dropped it in the classroom, Mark said, Bob, don't miss this one. It's easy. And he'll come back and he'll study that tomorrow. And then finally, the third tab, guys, because I firmly believe that recognition comes through repetition, that when you see something over and over and over again, it just kind of burns itself into your mind. So there's about 300 pictures of you guys using the software well. This dates back like a year and a half. I've been stealing pictures. There's the entry sequence, what it looks like to get into the high probability trend trade, both long and short, a very mechanical management plan for the beginner. If you're a NASDAQ trader, there's some ideas on the NASDAQ here. Patterns that repeat themselves. Guys, everything we do is just patterns. The market repeats itself. You have to learn those patterns so that you can catch those patterns in the moment. And then a whole section dedicated to termination conditions because that's really the most broken rule. So go back to the old slideshow here, guys. Post in the room as much as you can. There is not a number that's too much. And use your spreadsheet and go back and actually study it. I skipped the spreadsheet in the beginning and I didn't recognize anything. So we're going to learn the rules. We're going to learn the rules for the high probability trend trade. You guys are going to be able to focus on advantages. You're going to know when it's okay to trade. I want you simulating, practicing. Mess stuff up, right? It's simulator. It's like, I don't know, it's like getting foreclosed on in Monopoly. It doesn't have anything to do with your real life. It's all pretend. It's simulation. So get out there and mess some stuff up. The same way a pilot can crash a plane in the simulator so that he doesn't crash a plane in real life. Keep posting in the room until you're sure you have the correct rules, until you're trading with advantages. The idea is that you don't want to get lucky. You don't want to go, hey, look, Mark, I made $10 million on simulator. And I guarantee half the class has done that before. Well, Bob, you missed every rule and you traded into areas and there was no momentum and things were horrible. And Bob says, yeah, but Mark, I made $1,000. Well, you didn't. You made $1,000 for $10. And that short-term victory on simulator usually turns into long-term failure once you go live. We're going to simplify heavily. We're going to talk about a high probability trend trade. We're going to focus on the looks so they're easy. The more pictures you take, the easier the looks become. Taking pictures of each rule individually, taking pictures of the rules together, taking pictures of trades that you take, taking pictures of things that you see on the chart. The more pictures you take, guys, the easier it gets. I always encourage new users, take 15 pictures a day and annotate them, write on them, talk exactly about what you see. That's 300 pictures in a month, guys, and that's a lot of clarity by the end of the month. That's 900 pictures over a 90-day study. It's pretty amazing how easy things become when you've seen something 1,000 times. So recognition does come through repetition. Make sure that you're being thorough with what you're writing on the chart. Don't just talk about, I won, I lost, I got in here. Talk about your rules, right? I'm coming from what we call a good top, that termination that reverses the market. And I had strong trigger lines. And then, oh no, that was a termination condition. That was breaking my rules, and I lost this trade. So, what you've done is you've identified the positives, you've identified the negatives, and you see the reaction that comes from not having all positives. So, we're going to focus on the high probability trend trade, guys. We're going to break it down individually. There are 3 rules to the high probability trend trade. Each rule provides an advantage. I want you to begin to speak to yourselves in terms of advantages. So when you look at your chart, I don't want you to say, I think there's a long. I think there might be a short. I want you to say, I have momentum and I have a clear path and I have an entry area. My rules are met, so I'm going to take a trade. And what you'll find is the more you speak in terms of advantages, the easier it becomes to recognize the trades a little earlier, the easier it becomes to know when maybe you shouldn't be trading. And then ultimately, this is also going to help you understand what sort of management you need to use going into that plan. So the first rule is strong trigger lines, and that's going to provide you momentum. The second rule is no termination conditions, room to the profit targets. That's that likely to stop area, making sure that you're not trading into it. When there's nothing there, when there's no lines in front of you guys, you have a clear path, and that clear path means that you have room to your profit targets. That's the second advantage. And then finally, we're going to define the entry area where the market is most likely to continue. And this is the third advantage, getting in at that continuation point. So a trade isn't a desire to be profitable. A trade isn't a hope that it goes up or down. A trade is the combination of momentum, a clear path, and an entry area. And this is all going to happen on only 2 charts. And 2 charts is pretty simple, but it's even more simple when you realize that your first 2 rules will be defined by the most current bar on the large chart. Your first 2 rules will come to be on only 1 bar on the large chart. Your large chart is going to define the direction of the market. It's going to define the momentum in the market. That's rule number 1, strong trigger lines giving you the advantage of momentum. And it's also going to let you know whether or not you've reached one of those areas that have been problematic. That's rule number 2 that can give you a clear path. And all of that happens on just 1 bar. When you have those rules true, when the first 2 advantages are there, you're going to define your entry point. But you're going to do that on a smaller, faster chart, because your entry chart it's this refinement tool, and it takes that broad stroke of a brush, good morning JW, that the large chart is, and it's going to break that 1 bar, that most current bar, into about 15 to 30 bars, typically 20 to 30, I think. And what you're going to do is you're going to take the advantages from this chart and refine it into an entry on this chart. And it's going to allow you to buy low. It's going to allow you to sell high. And it's really going to allow you to reduce your risk and increase your profit potential. So your rule number 3, your entry rule, is going to happen on the smaller, faster chart. So we're going to break down each rule individually. We're going to go look at them in the live market. We're going to talk about it extensively. You guys are going to raise your hand if you have a question. But rule number 1 says that the large chart must have strong trigger lines. The large chart, the one that defines direction and momentum, must have strong trigger lines. And the only way to do that is if you're trading with the direction of the market, guys. If the background on your large chart is green, it's going up, and you should only be looking for rules to be met for high probability trend trades long as a brand new user. If the background on your large chart is red, you should only be looking for rules to be met for high probability trend trade short as a brand new user. And guys, the only way that you can have strong trigger lines on a large chart is if your trigger lines are the same color as the background. If the background is green and the market's going up, well, then your small triggers, these solid lines, and your large triggers, these dashed lines, they have to both be green. If they're not, you don't have strong triggers. They must be wide, not flat. If they're not, oh, absolutely, 10K. Are you going to be around today for the class? Tell you what, let me get through 3 rules, and then that'll be the first thing I do after the rules to go through it for you. But check this out. That's okay. I've got no flow anyway. Just ask my wife. Um, I've got a bajillion pictures, but let me find the ones that help define how to do it. So let me drop these in the room for you. Take a look at them, but I'll still go over it. But 10K, you've been around long enough that I know you're pretty smart. Check those out and see if it helps. And then if you need a little more help, we'll do it after the rules. Thank you for posting that in there, guys. And always do that. Don't be afraid to interrupt the flow. We're going to be just fine, I promise. So the background's green. The triggers must be green. The triggers must be wide, the space, they're open and angled in the direction of the trend, guys. This is the only way to have strong triggers. And strong is defined when the strong triggers are up and above the large triggers. There's space between the small and the large. I always tell people, picture scissors that are open. And when the scissors are open, the momentum is its strongest. And when we have strong triggers, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum, you're going to hear it in class all day long. Did you have odds favorable momentum, or was that advantage gone? In a downtrend, both triggers must be red, and I want you to see this. One is green, one is red. I don't have odds favorable momentum yet. When the large triggers roll over and begin to widen, now I've got those open scissors. Now I got that separation between the two. Now I have what we call odds favorable momentum. This means that the market is likely to continue in the direction of the trend. So when we have strong triggers up, when we have strong triggers down, we're going to buy Fibonacci support on a smaller, faster chart to go with that up, or we're going to sell Fibonacci resistance on a smaller, faster chart. On your large chart, on that one bar that defines everything, you're going to see these tails or these wicks. And we don't trade them, but you'll be able to use them for study. You're literally going to be able to use that refinement chart and know exactly where the top of that tail is most likely to form, or you're going to know exactly where the bottom of that tail is most likely to form through the refinement process. So sticking with strong triggers, guys, it sets the tone. Strong triggers push the market. Strong triggers break areas. Strong triggers even cover mistakes that new users make. And when I have odds favorable momentum, short trades, it's the best. And we're going to pinpoint where the market is most likely to continue. We're going to sell high, and we're going to ride that wave of momentum like we were surfing the pipeline. And then momentum doesn't last forever, right? All good things go at some point. So when the triggers are all down, when one of the two trigger lines gets inside of the large triggers, this is the first sign that momentum is slowing. You can see that the scissors are closing. Short trades may still be taken, but you want to make sure everything's right. When you're giving up that momentum, you want the other charts to tell you that everything is perfect, because that advantage is going away. And then when both triggers are down, once both of the small triggers are inside of the large triggers, the scissors have closed, you have a weakening or a slowing of the trend. And anything can happen. You're going to hear it in class all the time, guys. Anything can happen triggers is the term that you're going to hear. And you can still take a short trade. But man, they have to be managed assertively. And it's difficult to manage assertively until you're proficient at reading charts. So for the brand new user, that's the best of the best. Let's focus on this and getting the best entries, and understand that the foundation that you're building is going to get you to where you can take and manage these trades when everything still says down. I also want to point out as we get into rule number 2 that Fibonacci support and weak triggers, that may stop the market, guys. Weak triggers into an area, it's not as likely to break as if we have those powerhouse strong triggers going into it. And areas break all day. If they didn't, we'd be caught in this little rattle stage in between two lines. So rule number 1 gave us strong trigger lines. Rule number 1 provides us the advantage of momentum. Rule number 2 says termination conditions false, guys. Room to the targets. We have to have a clear path because we don't want the market bouncing off of something. I'm going to tell you, when we talk about termination conditions, and let me just pull up the picture. I'm pulling up all my pictures today for you guys. We're going to use lines on a chart, on a large chart, to define problems, to define challenges, to define areas. And we're going to use these lines, and they're going to let us know if they're likely to stop the market, if these areas have the potential to break, or if these areas have broken. The trigger lines are going to help us with that. But these lines are where decisions are made, is the best way to put it. The lines on the large chart that are going to define the areas, they're just where decisions are made. They're where the people in charge are taking profits. They're where the people in charge are entering positions. They're where the people in charge, the people that move the market, who it turns out aren't us, may end up fighting one another. And the reality is once you can identify termination conditions, once you understand when that clear path is no longer present, you can sidestep and avoid that fight. You don't have to be in it. If you've got a little experience trading and you've been chewed up in consolidation, you're going to find that rule number 2 is going to help protect you from that. Rule number 1 is going to help protect you from that. So rule number 2 is going to happen on the large chart. We already have direction. We already have momentum. You can see the separation there. So now we need to make sure that there's no problems in the way, no areas in the way. A termination condition is a Fibonacci-based indicator that may reverse the market. It is based on a comparison of the Fibonacci area and the trigger lines, those same trigger lines that gave us strength. So we are going to look for blue Fibonacci support, red Fibonacci resistance, yellow 1-to-1 dots. We're going to look for cyan divergence lows and magenta divergence highs. And for those of you that aren't familiar with the idea of divergence, all it means is that there was a loss of momentum. You'll see these lines on your charts print from the tops of pivots or the bottoms of pivots. And if it prints, you just say, oh, okay, there was a loss of momentum. That's it. I'm going to teach you how to use it to determine when it can be problematic. We're also going to look at those same divergences in the same area. And then on our large chart, the mid-band can be a termination, but there's a little thing. Those large triggers have to be a full bar away. I'm going to show you an example of that as well. But the recipe for defining a termination condition is pretty simple. It all begins with price reaching the area. When I say price reaches the area, what I'm talking about is those dynamic Renko bars, those price bars. They come down and they reach Fibonacci support in this case. So after the price reaches any Fibonacci support, check the trigger lines. If they're not below the support, don't take any more trend trades on the small chart. Don't try to buy high if you've reached the area. And guys, the recipe is consistent and it happens all day long. If price reaches the area, support, the triggers remain above, sit on your hands and do nothing. You don't know if it's going to bounce. You don't know if it's going to reverse. You don't know if there's going to be one of those fights that are happening between the people in charge. So it's really pretty concrete. Reach an area, triggers remain above, sit on your hands. And remember, the weaker the triggers, the more likely it is to hold. The stronger the triggers, the more potential there is to break. And I want you to see this. Up here, price reaches Fibonacci support. The triggers remain above, so you guys say to yourselves, man, I have to wait for a second. Let's see what's happening. But look at the momentum in the market. And what happens eventually is your small triggers absolutely smash through the area. And when small triggers smash through an area with that much momentum, these areas have the potential to break. They're not broken yet, but they do have the potential to break, which means that, let's keep it on the Sony Walkman, that you need to pause for a second and you need to say, okay, the area is not broken. Let me make sure I have the best momentum. Let me make sure that my entry looks amazing. And this look, when the smalls break but the large are still up here, we call this a 50-50 look. It's not the chances of survival. It just means that momentum may break the area, but it's not broken yet, which means that you don't have a clear path. This will be your first medium probability trade. The areas are considered broken. The path is considered clear when both the small and the large triggers get below support. And once the small and large get below support, you can see that support begins to behave as resistance. Both triggers are down. The momentum is amazing. What do you say we sell high? Let's identify where it's most likely to continue on a smaller, faster chart and ride that momentum down. So there's really 3 options at areas. The first option, and I'm going to pull it up here. The first option is that if price reaches and absolutely no trigger lines get through this area of resistance, the area is not broken. The path is not clear. You need to sit on your hands and wait for just a minute to see what happens. If the small triggers smash, embrace that word smash, through the area, but the large triggers are lagging behind, this area has the potential to break, but it's still not broken. It's not a clear path. And then finally, when the small and the large get above the area is now broken. Resistance behaves as support. It's not the color of the fib that defines whether or not it's broken. It's the position of the triggers. Once that area is broken, if the momentum is present, let's look for our best of the best entry. Let's look for an opportunity to take that trade to the north. So, man, I opened a lot of stuff. Price reaches, no triggers, let's sit on our hands. Is everybody okay with that? I ask a lot in the room. Are you guys good with this? Does that make sense? Are you comfortable? I always appreciate it if you give me a why. Let me know that I'm not leaving somebody behind. If you're brand new, day one, it's a lot. Day two, it gets easier. Day three, you're like, wow, look how smart I am. Takes a second to get the terminology down. So let's go through the exact same recipe for termination conditions, guys. Price is pushing up. Dynamic Renko bars are up. Even the small triggers are starting to peak above the large, and you're saying, wow, momentum. And then it reaches Fibonacci resistance. And once it does, all you have to do is ask yourself, where are my triggers? If they remain below the area, as they have, no long trades. Let's sit on our hands. Let's do nothing. Let's see what the reaction is. Sure enough, there's a giant push. There was a truckload of sellers waiting for them, and they push the market all the way down to Fibonacci support. They push it all the way down to that mid-band area. When they do, the triggers are a mile above. They're not even close to breaking that area. So you guys said, man, I can't go short, but I also couldn't go long. Remember that little consolidation. Rule number 2 is helping us define it. So from resistance to support, and when I get to support, all the triggers are above. That tells me no short trades. And from this mid-band area, look how far away the large triggers are. There was room for an entire Renko bar to form, a whole reversal bar to form. That lets me know that the mid-band is behaving as a termination condition as well. So no longs, no shorts, and then the market comes up to Fibonacci resistance. The triggers remain below. It also comes up to this divergence high line. Remember I said that divergence is just a loss of momentum, guys. This is a termination condition with or without the divergence line. The divergence line doesn't even print till all the way down here when the calculation's done. But when price reaches a divergence line and the trigger lines remain below, now it's a termination condition. Now it's an area that may stop the market. We call this a pivot stop out. And the pivot stop outs are strong. They're even more strong when they're coupled with resistance or support. The price also hits a second resistance band, and it can't go anywhere. The triggers remain below. So you guys had to sit on your hands. 90% of your time is going through waiting for advantages. Couldn't go long. Or if you were long, maybe you took profits there. Couldn't go short. Not going long, don't have momentum, don't have a clear path. And then a magical thing happens, guys. From this termination, from this pivot stop out, notice that your large triggers go from green to red, the smaller below. This is a reversal right off a termination condition. We call this a strong top. When you have a strong top, this sets you up for the highest probability trend trade that you can take. It gives you momentum, separation between the small and the large. That most current bar hasn't reached support. It's reached a mid-band, but the large triggers aren't a full bar away. The path is clear, and you guys just pinpointed right where it's most likely to continue. It looks like a tail on the large chart, but you used a small chart to sell high, and you rode that momentum down, guys. And this is your best of the best. This is your highest probability trend trade. So it's teaching you to recognize momentum, and it's teaching you to recognize termination conditions. It's really just getting you to the point to where you can look at your large chart and decide whether or not you have the advantages to look for an entry. I love this picture because the market is screaming to the downside and there isn't one pullback. Nobody got short unless they just jumped in. All that momentum just crushes Fibonacci support. It doesn't even blink at the area. The sellers are full tilt boogie to the downside. And then when it reaches the 1-to-1s, those trigger lines remain above. In Nexgen users, this is where the average human goes short directly into a termination condition because they feel entitled to get that short trade because they didn't get any part of this move. And the reality is it's not all your money. Every move can't be your move. So when price reaches, hopefully you guys say the triggers are above, I'm not going short. And if you said it, you didn't take a loser. And then it pushes all the way up to resistance and you see those green triggers and you're thinking, oh my gosh, I better go long. But all the triggers are below resistance. And if you just refrained, you didn't take a loser. And you're not going short back into terminations. You skip another loser and another and another. And guys, this is 45 minutes of a fight between buyers and sellers. 45 minutes of them jockeying for position. Ultimately, the termination creates a reversal. That's a strong bottom. The strong reversal gives you momentum and a clear path and a pullback right to an area on a smaller, faster chart. Not giving it up here allows you to capitalize on the highest probability trend trade that we teach. Not getting caught in consolidation, not getting caught in the middle of that fight, not giving away $1,000 hoping and wishing allows you to keep the results of the highest probability trend trade here, guys. So the patience is so important. Is everybody good with the very basic? If price reaches the area, the triggers remain above support, below resistance, just pause for a second. Wait to see what happens. And I'm telling you, as you grow with the software, you'll get to a point to where you'll find more opportunities. There's more opportunities the better you are at reading charts, but this is designed to keep you out of that fight. Sometimes it turns from nowhere. Everything is down and the market goes up, and everything is up, even with strength, and the market goes down. So the way lines define problems on the large chart, we're going to use lines on a small chart for entry, but there is a termination condition that you will see on a small chart. And you'll see it there because the small chart's faster, because the small chart's throwing 15 to 30 bars out for every 1 bar on the large chart. So we're going to use the divergence, that loss of momentum on the small chart, and we're going to use it to see change that we can't see on that large chart. So 3 divergences in the same price range may terminate the trend. May is the key word, guys. It may just push it up a little bit before it continues. But 3 divergences in the same price range is a termination condition. 3 divergences in the same price range is rule not met. And that's what I want you to get out of the divergences. If 3 of them print, your rules are no longer met for a high probability trend trade. It becomes more powerful if your small triggers work their way inside of the large triggers. That's that anything can happen look, letting you see visually that you're losing that momentum. And then finally, if that third pivot's higher than the previous, that's problematic, guys. It's creating a head and shoulders patterns at highs and lows, which just adds fuel to the fire. So you're going to see 3 at a low or 3 at a high, and what it's going to do for you is help you recognize when the market may be changing, but you can't see it on a large chart just yet. And this is going to get you the advantage of a clear path. When the rules are met and you're not trading in determinations, you're going to have a clear path. And when you've got just a metric ton of momentum behind it, it's hard to stop a market. It really is. So your large chart has defined direction for you. That direction is up in this particular chart. The background is green. This is the easiest lesson that you're ever going to get. The large chart has defined momentum. It's not hard to recognize. The scissors are open. Smalls are above the large. Everything is green. Everything is wide. This is a market that's likely to continue in the direction of the trend. Rule number 1 is in place. And it defined the areas. We have not reached Fibonacci resistance yet. So Fibonacci resistance is a target, not a termination condition. And we've already bypassed all the areas below us, so our path is clear. Rule number 2 is in place, guys. All we have to do now is take these advantages and we're going to refine them on a smaller, faster chart. We're going to find the best of the best entry where the market is most likely to continue. And we're going to do that with such precision that our entry rules say that we're going to use a limit order. We're literally going to wait for the market to come to us. We're going to use a limit order to buy or sell a pullback, a small retracement in price. When the large chart says up, when the large chart says clear path, let me find my picture. All it's telling you is that the large crowd, the people in charge, the people that have the money, that push the market, that create the trends, man, they want everything to go up. And there's always this group of yahoos that are like, hey, large chart, large crowd, we're going to go ahead and fight you, right? We've got pink mohawks and safety pins through our noses, damn the system. And they're gonna put their money together, and they're gonna try and push against everything going on. Next-gen users rely on this small crowd. This is what gets us to our best entry. So we're gonna use a limit order to buy or sell a pullback, that little shove, and we're gonna do it at areas. Areas define problems on the large chart. Areas define entries on the small chart. But the key is we want them to be at the trigger lines. We want them to be inside of the trigger lines. Your trigger lines are nothing more than a correction point. It's a moving average. The market tends to come back and correct to trigger lines. So on your small chart, we're going to use large trigger lines, the same ones that are going to have you defining momentum. And we're going to use synthetic triggers. These are the large triggers from your large chart. They're superimposed on the small chart, because when the large and the synthetic are one on top of the other, when the large and the synthetic are riding piggyback, what it does is it creates the smallest amount of space for there to be lines inside of them. And this creates your smallest window of opportunity where the market is most likely to continue. And this is going to allow you to have the least amount of risk on a trade. So we don't trade from trigger lines. We trade pullbacks to areas inside of trigger lines. We let the small crowd do their thing to get us back to where we need to be. So rule number 3 is going to pinpoint exactly where the market is most likely to continue. So I'm going to show you how we piece this together. But when the large chart, oops, I lost my slideshow. When the large chart says up, when the large chart says the path is clear, when the large chart says that everything is perfect to look for an entry, we're going to buy low on the smaller, faster chart. We're literally going to be able to buy the market as it pulls back to us, giving us the least amount of risk. And then when everything is down on the large chart, when it's absolutely screaming in the direction and there's nothing in the way, we're going to sell high on the smaller, faster chart. And we're going to be able to do that through the refinement process. When the large chart says down, when the large chart has momentum, when the large chart has the potential to break the area, if you look at the most current bar, if you look at the bottom line or the bottom of the most current bar, it will be the beginning of the pullback on the smaller, faster chart. The top of the bar, ideally, is going to be an area of resistance inside of favorable large triggers. So everything that happens from the bottom to the top is an entire pullback, hopefully to our perfect entry, where we're going to sell high, which is going to increase our profit potential. So we're going to take this refinement process, and when the large chart says go, when the large chart says momentum, the large chart says clear path, the large chart says go find an entry because life is good, whoops, we're going to wait for a reversal bar on the smaller, faster chart. And guys, I want to share this with you. This entry sequence that I'm going through for longs and shorts, I've got them in that spreadsheet for you. We'll go through one of them together, but we're going to wait for a reversal bar. A reversal bar lets us know that the small crowd is fighting the big crowd. And at the time of the reversal bar, the only thing you have to do is first identify your trigger lines. Are they tight, one on top of the other? Are they what we call favorable? And then look inside of them. Where are the areas? Where are the fibs? Where are the mid bands? Where are the yellow 1-to-1s? Because price is likely to return to the trigger lines, but we want to give it a spot to bounce. And I want you to picture in your head, you have a tennis ball, a racquetball, a cricket ball, whatever floats your boat, and you're going to throw it as hard as you can at a brick wall that's 20 feet away. It's not going to ricochet before it hits that wall, right? And these triggers don't have enough substance to create that bounce. So we're going to give it the mid band. We're going to give it yellow 1-to-1s. We're going to give it a fib, but we're going to put them right inside of that correction point, guys. And you're going to define your window of opportunity from the highest point of support to the lowest point of support inside of favorable large triggers. This is where the market is most likely to continue. This is where the bounce is most likely to happen. Guys, this is where the magic happens. This is where you've identified where the market is most likely to continue, and you're in a long trade. You're going to put your limit order at the highest point because of the momentum on the large chart. You're going to put your limit order at the highest point because there's a clear path on the large chart. And when you're going short, it's the exact same look. Everything on the large chart must say that it's time to go short. Turn your attention to the smaller faster. Wait for the reversal bar. At the time of the reversal bar, find your triggers. Are they wide? Are they angled down? Are they one on top of the other? And then just see what lines fall within. In this case, it's nothing more than a mid-band. That's it. I've got one line, one point where the market is most likely to continue. I'm going to activate a limit order just below it and hope for the best. Notice that there's fibs and yellow 1-to-1s up here, but they're outside of the trigger lines. They're not in that correction point. They're actually beyond the correction point, which it doesn't make sense, right? If this is where it's supposed to correct, why on earth am I looking at the lines beyond that point? So we're looking for the areas inside of favorable large triggers. And when you put the two charts together, buying low, selling high creates this huge advantage. If this is your most current bar, notice that it has the tail. I can circle the tail on the large chart. I'm not trading the tail. It's the pullback here. But at the top of the bar, I've got $40 to get to my trouble. $40 to get to my termination conditions. Guys, that's not enough money, right? And at this point, a lot of you are going, well, I just have to write off the trade. I can't take that trade. It's so close to my trouble. If you wait for the reversal bar, if you identify the areas and you get in low, you get in at the areas inside of triggers, guys, that 40 or $50 turns into 250 because you're buying a pullback. And this is really the awesomeness of what we do, is when the large chart says go, when the large chart is screaming to the upside with nothing in the way and room to the target, we're going to rely on this pattern, these fluctuations that happen every day. We're going to let that pullback come to the area inside of favorable large triggers. We're going to have reduced risk, and we're going to increase our profit potential. Because instead of only having 10 points, we now have 20. And it makes life easier for you guys. And I want you to focus on getting in at the correct area, getting in at the point where the market is most likely to continue. I want to go through one more, and we're going to do it bar by bar. The first step is making sure that the rules are met on the large chart. And this is straight from the spreadsheet, guys. You have this little scenario in there. So when the rules are met on the large chart, wait for the reversal bar on the small chart. That's it. Wait for the pushback. If it never happens, guys, then you're just not going to get into the market. We rely on the pullback. So once you get the reversal bar, let's look for those trigger lines. Are they wide? Are they angled in the direction? Are they overlapping? Remember, the wider they are from one another, the further apart, the less overlapping they are, the bigger the range is where the market may continue. So I see my triggers, and I'm like, all right, they look good. They're strong. They're down. Let me find the areas within. From the mid-band to resistance, your window of opportunity, the point where the market is most likely to continue, will extend from the closest resistance to price to the furthest resistance to price, the lowest point of resistance to the highest point of resistance. And this shaded box lets me know where the market is most likely to continue. It lets me know where that bounce should happen. It lets me know where I want to activate my limit order. And I want to activate my limit order at the bottom of that window because this chart is screaming to the downside. So this yellow line is my limit order, a tick or two below that lowest point of resistance. And now it's time to pray. Pull out the rosaries, guys, because you've done all that you can do. You can't force the pullback. You can't make them come get you. You can't even make the trade work. But if the market comes back and it hits your limit order, you're in a short trade. And guys, you're in a short trade with odds favorable momentum. You're in a short trade with absolutely nothing in the way on the chart that defines the areas. And you're in where the market is most likely to continue. And this is a trade that typically wins 70 to 80% of the time when the rules are followed. This is a trade that typically wins more than it loses, that creates confidence through the memory of success. And then the best part about it is once you know where the market is most likely to continue, well, then you understand completely where the market shouldn't go. Your window of opportunity defines where the market should bounce. So your initial stop as you learn to manage trades is going to go 4 or 5 ticks beyond that window, beyond that highest point. And if the market moves beyond it, if it hits your stop, guys, you're going to take a loser. Write it down, hang a picture on the wall. I want you to say to yourself every day, I'm probably going to lose a couple today. Because anything that wins 70 to 80% of the time is obligated to lose 20 to 30. I'm going to take a loss, but I'm going to take a small loss because I know where the market's likely to continue. I'm going to take a small loss because I know that if it goes beyond there, I don't want to be in the trade. It's a normal part of a positive equity curve. And then the cool thing is once that short trade makes a down bar, you're going to reduce your risk even more. You're going to go a tick or two above that reversal bar. So even if it comes back and gets you, guys, I've seen traders lose $20 or $30 on a trade, and they're like, that's no big deal. That's lunch. Same thing. Get the up bar, the stop moves, the risk is reduced, life is good. And that's the first step in management, guys. The first step in management is understanding where the market is likely to continue. You manage your risk by understanding that odds favorable momentum means it's likely to push. You manage your risk by understanding that when you haven't hit an area, it's more likely to continue that direction. You reduce your risk, you manage your risk by getting in where it's most likely to continue and by having a stop where it shouldn't go. And there's going to be times, guys, where everything is perfect and you take that entry and you move your stop and it's going to come get you. Take the small loss and wait for the next trade. So often I see people saying, man, but I really hope. And they move their stops way off in the distance and they just take a bigger loss. I also see people jumping in up here afraid that it's going to leave them. And all they've done is increase their risk and lower their profit potential. So 20 days, 20 days, guys, of focusing on getting in where it's most likely to continue. 20 days of just getting in at the best spot, 20 days of learning to read advantages, 20 days of keeping it simple, keeping it focused. And what you're going to find is that everything opens up for you. Life gets easy once you're a chart reader. So the second half of this lesson, and before I get to it, are there any questions? Are there any questions about momentum? Are there any questions about the idea that strong triggers save lives, that the separation between the two is the reason that we buy low, is the reason that we sell high? Guys, this is the advantage that I would encourage you to never do without. I won't tell you how to trade, but I'm telling you that's a big one. And then once you have it, making sure you understand whether or not you have a clear path or you're into a termination condition or if the area is likely to break. Because when you understand this concept, it lets you know that with that momentum, you have a clear path. And then finally, being able to bring it back to that best of the best area, to bring it back to that area where the market is most likely to continue. Guys, this is your first 30 days. So this plan that I'm giving you right now is a stepping stone in your learning journey. It's just teaching you to be a chart reader. It's teaching you to recognize advantages, to speak to yourself in terms of advantages. And it's designed to optimize your chances of success with the high probability trend trade and the 50-50 trade. Remember that area with the potential to break. It's designed to optimize your chances of success because, guys, confidence comes from the memory of success. And the more you're able to consistently enter in the right spot, the easier your life becomes. The more readily you recognize these advantages, the faster your chart reads happen, the less likely you are to hesitate. So through simulation, study, class feedback, and continuous practice, you're going to be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. That is AI created mumbo jumbo to say, guys, when you're a chart reader, you're going to build your own plan. Once you understand what you're looking at, you're going to start to see opportunities everywhere. I had a gentleman send me a message this weekend. He goes, Mark, I keep circling these tails and I keep seeing these advantages. He goes, man, and I'm starting to see that there's a lot more opportunity than just the high probability trend trade. And of course, I got giddy because it means that he's learning to read his charts. He's learning to recognize patterns. He's learning to realize that life isn't just a high probability trend trade with the software. That's just getting you to the point to where you can find the rest of the trades. So your simple plan for consistency begins with don't fight the large chart. Just don't fight it. Don't fight trigger lines. Don't fight termination conditions. And the running joke for the last, I don't know, John probably made this 10 years ago, is how to create financial suicide. One easy step. Trade against strong triggers, guys. It's a surefire recipe for disaster more often than not for the new user. I'm going to say for the new user because if you've been reading charts for a year, you might find an opportunity. You may recognize a pattern that allows you to fight triggers when the conditions are right. We're going to see an example of that in just a second. Chapter 2 is don't trade into termination conditions. So as problematic as termination conditions can be to stop the trend, termination conditions can also set you up for a nice little push the other direction. So guys, I want you to see this chart, and I want you to know that this is where you're headed. The large chart says up. The large chart says strength. But the large chart does not have a clear path. Not at all. The large triggers are below, the small triggers are above. Guys, this area isn't broken. So Ron says, you know what I've realized, Mark, is that when the path isn't clear in divergence prints, I've got a really good shot of this chart making a reversal bar, and I'm finding a way to capitalize just this little snippet, just this quick little move where I scalp from the market. And I wanted to show this one before we get into the KISS plan, because this is a 50-50 trade. This is 50% above and 50% below. This is not a clear path. Rule number 2 is not met. And guys, some of you are about to have an aha moment. In the KISS plan, when we talk about it, divergence ruins this trade. Divergence kills the likelihood of you winning. So Ron said, if I can't go long because of this problem, why don't I find a way to go short? Why don't I find a way through my chart reading to get paid? So there's going to be a time where it's appropriate. There's going to be a time where you know how to do it. But in the beginning, don't fight it. Learn how to read. And then define your entry. You're going to come in and you're going to want to do what you see Ron doing. You're going to come in and you're going to want to see, man, Mike Lynch takes this trade. Gary takes this trade. GWC takes this trade. Miss Cindy keeps taking this trade and it doesn't look like the rules. And I want to take that trade even though I'm not a chart reader yet. And it's, guys, it's going to kill you. Stay in your lane. Know where you're at. That's like an 8-year-old little leaguer wanting to go hit home runs with Altuve. And they just can't. They're not there yet, but you'll get there. So do it by defining your entry, guys. Let it be the high probability trend trade. Understand the conditions that need to be met. Recognize the advantages. Commit them to memory until they're easy. Because I've never had anybody mark yes on all of these and do worse than 70%. So this is designed to optimize your chances of success. And then once you get into the market, guys, you got to learn how to manage it. That's the second half. Management requires your ability to read charts. And if your first entry is teaching you to read charts, well then management for the brand new user should be very mechanical and easy to follow and very pragmatic. And then there's that magic phrase again. You will craft a plan tailored to your personal goals based on your experience reading the indicators. Once again, AI. My brother had a kick where he fell in love with AI. Guys, you're going to make your own plan once you learn how to read charts. You're going to learn how to manage more effectively once you learn to read charts. But until you do, let your management plan revolve around getting in at the right spot. Let your management plan revolve around taking the absolute best trade that manages risk, that offers the least amount of losses, the highest chance of success, however you want to say it. You're going to put your stop where the market shouldn't go. And it's either going to hit your stop or it's not. And this simple stop placement where the market shouldn't go is effective because you're beyond the bounce point. You're beyond the correction point. And if it goes beyond there, you don't want it anyway. So the stop's in place and there's nothing to do. It's either going to get stopped out, totally normal, or it's going to give you a reversal bar. And once it gives you a reversal bar, the market is telling you, hey, guess what, Trevor? You had all that momentum and a clear path, right? Everything was screaming down for you. Well, guess what? We're going to go with that momentum and clear path. Go ahead and reduce your risk 2 ticks above it, and then back away. Don't do anything else. Let the market do what the market's going to do. Watch it, right? Like, don't go get a sandwich, but don't move your stop. Either let it get hit or let the market hit your first target. And for the brand new user, I've written this plan with a $100 target. You're trading 2 contracts because it allows you to build trust. It allows you to create confidence. So the first target's only $100 off, guys. And with that much momentum and a clear path, more often than not, it's difficult to not hit that target. It's challenging to not hit that target. And when you hit it, you feel good. That's $100 in your pocket. Life's pretty happy, and you're going to go to break even. And when you go break even, well, now you don't have any risk. I've been paid. I got nothing to lose. And it's just reminding me that that's the whole reason I'm short in the first place, because this market is screaming. So it makes it easier for the new user to hold for the second target. Second target's $200 in the distance. If you hit it, you're up $300. You're exiting the trade that's in your account, and you're feeling pretty awesome. You're like, man, this stuff works. I need to get better at it. I'm going to stick with it. This stuff works. I love making money. And some of you are going, but Mark, $300 isn't my goal. I have to make $3,000 a day. Guys, $300 a day is 72 grand a year. $72,000 a year on 2 contracts on the easiest trade, on the lamest management ever, right? It's not exciting. It's just if then. And then once you're a chart reader, doors start to open. Once you're a chart reader, you're going to add that 50-50 trade. And remember, the 50-50 trade is the area that's not quite broken yet, where the smalls break through but the large don't. So let me pull up my little slide ruler thing that I have here. The 50-50 trade is not a high probability trend trade because it doesn't have momentum, a clear path, and an entry area. The clear path has gone away. So once that goes away, the KISS plan, the easiest of the easy, is designed to make sure that you don't sacrifice momentum or an entry area because you don't want to give up 66% of your advantages. So on the 50-50 trade, it's telling you that you must have strong triggers on the large chart, that you must have strong triggers on the small chart, and no divergence on the small chart because that's a loss of momentum. Hey, Chris and Jamie, welcome to the room. Nice to have you. I'm Mark. I flap my gums. I answer your questions. I give you feedback. I'm excited to have you here. No divergence on the 5-1, guys. Divergence can kill a 50-50 trade. Divergence can shut it down and really just break your heart. And let me find, where did Ron's trade go? And I want to show you what happens when you start reading indicators. Is poor Ron had to sit on his hands forever and say, man, there's so much momentum and the market's going up, but it's a 50-50 trade with divergence. What the hell am I going to do now? Ron said, you know what? I'm going to see if there's a pattern that gets me paid. A lot of you guys were just getting stopped out. Ron was making money because he knows that divergence kills a 50-50. So it's designed to optimize your chances of success. It should be from a termination that creates a full reversal. Guys, if you can mark yes to all of these, the chances of you winning this medium probability trade go up exponentially. But it's still a medium probability trade. You have to manage it assertively. Notice that it reminds you again, if there's divergence, don't take the trade. Just that reminder, please don't take the trade with divergence. That kills it more than it doesn't. And you're still using your initial stop outside of the window. You're still using that reversal bar to reduce risk. But if divergence prints, notice before you ever talk profits, if divergence prints before you reach the profits, exit the trade. It's killing the trade. Your first target is $100. or at your first trouble spot, which means that you might make $50 on your first contract if you don't have room to get to that trouble spot. Your chart reading will tell you where it's at. And then quick profits on the second because it's not a high probability trend trade. So guys, the KISS plan is designed to optimize your chances of success. I'm going to drop that in the room for you. All you're doing is defining entries. All you're doing is saying, this is where I'm going to get in. Let me manage it pretty mellow. I'm also going to give you a trend trade checklist. Again, I've never had anybody mark yes to all of these and do worse than 70%. So print this out, put it on there, write these rules on your chart to make sure you know what you're looking at. I'm also going to give you a high probability trend trade checklist that has pictures. Is the market coming from a good top or bottom? That's what it looks like. There's your momentum, there's your momentum, there's your anything can happen, money taker. There's your termination, there's your clear path, there's your potential to break, and here's that window of opportunity, that best of the best. So guys, I'm going to give you this one, study it for 3 or 4 minutes before you start the day. Make sure you know what you're looking for. Keep this on your desk, make sure that you followed your rules. My goal for you is that you get to the point to where you never say, hey Mark, was this a trade? You say, hey Mark, my rules weren't met and I took it anyway and it didn't work out. So let's look at the live market. So newer users, help me out. The background is green. Are we going up or down? That's the first look. Should I be looking for trades long or short? What do you guys think? I've got a green background. Anybody? Nobody? That's okay. I understand this stuff. If you don't answer, I still know. Large chart says up. So my next step is to ask myself, do I have the advantage of momentum? Are both my large and small triggers wide and angled in the direction of the trend? Are they both green? No. So I don't have odds favorable momentum. Rule number 1's not met, guys. And honestly, it's okay for me to say my rule's not met, I'm going to do nothing. But if you're the gambling sort, price reached a mid-band, large triggers were a full bar away. Now, not only do I not have momentum, but I'm also looking at a termination condition above me. And I can't go short because price reached support and all the trigger lines are above it. 90% of my day is spent doing nothing. And guys, this is a great example of where it's easy to form an opinion, where it's easy to say, I think the market's going up because my triggers are above support, but you don't have the momentum to support it. And then on that same token, small triggers smash through the area. The momentum is the best. Do you see how this area had the potential to break at 76.88, but it didn't? And you guys were thinking, I'm going to take a short trade, but then divergence prints, and it keeps you out of the loser, guys. And your rules are just designed to keep you safe. Look at how the market continues with odds favorable momentum. Look at how the market pushes up with odds favorable momentum. The market is screaming down with odds favorable momentum. And if I circle a tail on the chart, let's see what it looks like on a smaller, faster chart. Was there an opportunity for entry? Did it pull back to resistance right inside of favorable large triggers? You're damn right it did. So your job is to go back and circle tails with momentum, guys, and see if your rules were met. And if they were, you have to take a picture of it, whether it's capture software or snag it. When you hit that big red button, if you hover over one chart, it gives you one chart. So we're going to click and drag from the top of the large chart to the bottom of the small chart. I want you guys to remember, get your timestamps in there, get your prices in there, because what we're going to do is we're going to line everything up. I want you to draw an arrow to the trigger lines first, and I want you to define them. Are they strong? Are they weak? Do I have the advantage of momentum? And I want you to point at the bottom of the bar that had the tail. Guys, we're doing this historically. And this is where I really want you to use the language. Price did not reach an area, not a termination condition. And then probably the most important, let's define the entry. Sold a pullback at an area inside of favorable large triggers. Do you see how I'm just using the language from the checklist so that I can come through and I can police myself? I can say to myself, hey, I did have strong triggers. I didn't reach an area. I had room to my target. So I waited for the pullback to resistance inside of favorable large triggers, and it took me all the way down to my profits. Does everybody see how this is a trade? This is what you want to be in. So share it. And then 10K, are you with me? Open up your spreadsheet, guys. This one fits the rules. I want this trade in my favorite looks. I didn't take it. I just went back historically and found it. But it fits my rules. It's what I want to do. So I'm going to right click on my chart and I'm going to paste. And I'm going to drop that screencast address in there. And this is cool, but it's messy, right? And you have to hold down Control to follow the link. So what I'm going to do is I'm going to go to Insert and over here to the link button. And when I click on the link button, it's going to insert a hyperlink. And a hyperlink just says, give me a couple words. You can click on them. It'll take you to the picture. So I'm going to repaste the address down here in the address bar. And I'm going to change the text to display. We'll call it Awesome Short, because this is what I want it to look like when I take a short. Once I click OK, I've got the Awesome Short button. So if I come back tomorrow and I click on it, well, that's what I want it to look like when I take a short trade. And then my perfect long, I click on it. That's what I want it to look like in order to get in long. And then beauty of a short, that's what I want it to look like when I'm taking the short. And the cool thing is, guys, is once you do that hyperlink a couple times, you're going to right click and it's going to default you to the link button. It's going to let you put in the hyperlink automatically without going to insert, without clicking that button. Did that help, 10K? So fill up your chart, guys. Fill up your spreadsheet every day. And do it like this. Open up your large chart first. And watch this. I want you to see how much information can come off of one picture without a trade being taken. I'm going to take a picture of my large chart. And I'm going to start on the left-hand side. And I'm just going to do this, rule 1, or I'm going to define it. These are strong triggers. Why am I doing this? I mean, this happened in the middle of the night. But strong triggers are always strong triggers, guys, which means that if I come over here, I can recognize strong triggers again. I'm drilling it into my head what it looks like when there's strength. And then look at this. There's strong triggers again. So what have I done? In one picture, I've got 3 pictures of strong triggers. So now I'm starting to commit it to memory. And then let's do the other side, right? Smalls inside of the large. Let's call it weak triggers. And do it again. Smalls inside of the large. Let me get my call out. Weak triggers. Is everybody with me so far? And guys, new users, this is so important. People that struggle with the concepts, this is so important. Because we're not just saying weak triggers and leaving it alone, right? That's the vision. But I want you to see what happens with the strong triggers. The market pushes all the way down. The market pushes all the way up. The market continues to push. What happens when the weak triggers happen? Let me change colors. When the weak triggers come into play, look at the retracement. Look at the retracement. So I'm starting to associate patterns with the lessons, with the strength. And now it just gets even better. This is still the same picture. Those are termination conditions. That's a termination condition. That's a termination condition. Where it reaches resistance here, that's a termination condition. Look at the bounce. Look at the bounce. So I'm creating this recognition through repetition. I'm creating this trust that strong triggers do, in fact, tend to push the market. I'm creating this trust that termination conditions can kill forward progress. I'm creating this trust that weak triggers may result in a deeper retracement. Or even more so, look at this, guys. Price reaches the mid-band and the large triggers were a full bar away, and sure enough, it closed the gap right to them. So without ever taking a trade, I'm beginning to reinforce these lessons. Without ever taking a trade, I'm starting to say, man, this is what it looks like when things are happening. And I'm creating awareness, recognition. From support all the way to the mid-band, large triggers don't follow. Straight down to that divergence low. Can anybody help me? I've got old eyes. Is it just me? Or did that market go one tick below that line in the sand? Does everybody see that? Why do we respect divergences? This is just a loss of momentum. One tick, guys, one tick, and that market changed direction. Developing trust in the idea that termination conditions are going to keep you out of trouble. That termination conditions are going to allow you to know when the market may reverse. Termination to the tick. Holy smokes. So I hope that makes sense to everybody. I hope you guys are kind of getting what I'm doing. That was crude oil. This is the Russell. Same drill, right? Strong triggers. One divergence, back to resistance. Down it goes to support. And you're going to start to see these patterns over and over. Termination, huge push. Large triggers don't follow. And sure enough, it closes the gap. The area breaks, it pulls back to it as resistance. There's that pivot stop out. One tick again. Guys, this pivot stop out is what started the push down. This termination condition. You guys knew about that line. You knew there wasn't momentum, and this termination started the whole push down. So it's just pattern recognition. That's all it is. That's my first hour, over and over. Flat triggers mean no momentum. No triggers through support says don't take the short. Rules for the win. Guys, I'm going to take a few minutes. You've got your spreadsheet. You've got your rules. You know how to take a picture. You know how to use a spreadsheet. If you don't, it's your job to raise your hand. I can't see your face. I don't know if you need help. I need you to tell me if you need help. I'm going to take 5 minutes. I'm going to get out of here. I'm going to reload my water, maybe have a popsicle. Who knows? When I come back, we're going to look at the pictures that you guys have posted. And we're going to look at the pictures and talk about them in terms of advantages. That's it. No matter what kind of trade, we're going to talk about momentum, a clear path, and an entry. We're going to talk about whether or not your rules were met or not, which means, guys, I need you writing your rules on your chart. I need you telling me why you did what you did. The whole idea of feedback is to be able to help you become a chart reader. And if you don't tell me how you're reading the chart, then it doesn't give me the ability to give you the best feedback. So I'll be back in 5 minutes. When I come back, we'll look at charts. We'll look at the live market. If something sets up, we'll play on Simulator together. It'll be a lot of fun. I'll see you guys in 5. brilliant. Awesome. Cool. All right, y'all, let's get into that second hour. Termination condition still seems to be holding, doesn't it? What an awesome thing to be able to recognize, to not sit and go, man, I hope this works out. So I'm going to scroll up to the top of the room. I'm going to look at the charts that you guys have posted. I am going to respectfully request, if I miss your chart for some reason, just tell me. Don't go, man, I can't believe he skipped me. Go, hey, Mark, we missed one at 9:15, and I'll take care of you. So, Gino. All right. So here's one cool thing, is I'm going to talk about rules, right? And we're just going to go through and we're going to look at it. And hopefully you're in here. This is one of my favorite things. Where's my shape thing? I thought we were going to go down. So Gino, you thought we were going to go down, right? The background was red. And you said weakening triggers, which means that, and then just for me, this means momentum not best, but still down and not bad, right? So we're kind of like, all right, they're slowing a little bit. I'm going to show you how to use these two things to kind of work through it, Gino. If the momentum appears to be weakening here, you can kind of confirm that things are going a little sideways when you start seeing stuff like this, when you start seeing multiple divergences, when you start seeing small triggers inside of the large. So this kind of lets me know that momentum is, and this is a confirmation is kind of starting to stink. Does that make sense? This is a great large chart, small chart comparison. The large chart's not perfect, and the small chart's getting even worse. You're probably losing momentum more than the large chart is letting on. Does that make sense, Gino? And this is one of those chart reads, and this takes a little bit of time to be able to grasp in the moment. And then what you're going to find, Gino, more often than not, and it was actually two divergences on the small chart, not just one, is when the momentum starts to go and your areas for a bounce start to fall. Oh yeah, you got in early. You didn't wait for an area. You just jumped in at the triggers. So we're back to that. That's cool. So if we go through rule number 3, man, you just didn't want to miss that move. If my areas, and I'm going to put this in all caps, bounce point, are beyond the correction. Gino, you remember the lesson, right? Trades don't come from the triggers. They come from the areas inside of triggers. And why is that? You did it inside the triggers, but you don't have an area until all the way up here. You see that? That's just triggers. Triggers is like that big pocket of air before you get to something to bounce off of. Trades don't come from the triggers. Trades come from the areas, especially if you don't have momentum and you're confirming that the momentum is going away. Man, it's a great idea to make sure you have something to bounce off of. Is that making sense so far? So not only is momentum going away, and I'm not going to lie, Gino, on your large chart, I like the look for short. I really do. You have a clear path. They're not totally weak in triggers. The large chart suggests, man, we're probably going down more. It does. Your small chart told you, just be patient, brother. And when you had the two divergences, it confirmed that momentum was pretty bad. When you didn't have any areas inside of the triggers, it lets you know that even a reversal bar puts you at the correction point, but you don't have the level of momentum that you would expect it to just fall out of bed. So there's a couple things there if you go back to the rules. It look to you, one of those large chart would be one neutral but continue lower, and you sold it on the first divergence. There's only one when you put it in. There was only one. Okay, so let's do this. What did your trigger lines look like? They look small, right? Or they're starting to work inside of the large here the same way they are here. I get it. What kind of trade is this? And maybe that's what I'm missing, is what kind of trade is it? Where when you don't have momentum, but you hope it's going to finish down anyway. Because it can't be a momentum trade, right? Because the momentum's not there. But I'm going to show you guys something. This is how we build trust. Weak triggers, bigger retracement. Weak triggers, bigger retracement. Weak triggers, bigger retracement. Weak triggers, bigger retracement. So what we're starting to see is that when they return, that market tends to push a little lower. No, it's a good read on the large chart. It really is. It's a great read on the large chart. It's a solid read on the large chart. The large chart says down. And this is where adherence to the rules, speaking to yourself in terms of the rules, helps a lot. You don't have entry rules for a trend trade. So all that means to me is that I can't take a trend trade because my rules aren't met. It's really that simple. So if I enter the trade, what kind of trade am I taking? And maybe this is where the aha moment happens. So if I enter the trade, what kind of trade am I taking? If I jump in, hoping that it just continues, Gino, would it make sense that momentum would be an outstanding thing to have? I feel like it would. So we're taking that chart read in the moment. Okay. It's hard to read your charts, but at the time of entry, your small triggers are inside of the large. Let's talk about momentum phase real quick, Gina. I'm going to find a way to make this as easy as I possibly can. Let me see. I've got so many pictures. I want to find the one. So, Gina, I want to use a safeguard. No, it's okay. I love the large chart. I will swear to my dying breath that your large chart was good. I just want to try and give you a way to avoid this one. Okay. So if you get everything, why did you post it in the room? What did you hope to get from me? I'm obligated to give feedback. I want to give you feedback. This is what helps me on that momentum look on the smaller chart, Gino, when the large chart looks good, is I'll literally look at the bar placement versus my trigger lines, the small triggers even. So when the bars are outside, we're still cranking. As they begin to pull inside and get to the other side, we're losing momentum. And I love it, dude. On the first divergence, everything looks good. Everything looks good. It's just by the time we got to the second, do you see how the bars started working their way inside and started pulling to the other side? It's just a little visual. That's all I'm trying to give you, is a little idea of maybe how to not take that trade. Because now we're on the wrong side of the momentum phase. You got out at 87. You were in at 78. Second divergence printed 1 bar after your entry. Probably right around 80. That's just how the software works. It prints on the third bar. And it may have happened really fast. It may have happened really fast. But you were still in after second divergence. I'll take it if you want it, Gino. If you're looking for something that relies on momentum, let the bars be outside of the small triggers. It'll help you. I promise. If you're looking for a momentum style trade, let the bars be outside. It'll help. I promise. You can use it or not. It's up to you. But you put it in the room, so I'm obligated to talk about what I see. That's what I do. And guys, you probably won't always like what I have to say. Andy, let's see what we did. The trade's so nice, you posted twice. All right, advantageous triggers following the same path. Entry into two areas inside larger synthetic triggers. Place your entry before the mid-band, but it reached the yellow 1-to-1s. In the same vicinity, took a quick 80 on a 5-lot. John would have taken 3 or 4 trades by now and not let so much money get away. Guys, I would encourage everybody, don't try to do what John Novak does. My brother reads charts so fast, it's difficult for him to mess things up. But I love this because you've got a termination. The large triggers never even blink. Resistance says it's going to hold. And then once the smalls begin to break below, it's the same look here, right? You're in the momentum phase. Everything says down. It pulls right back to one area inside, right? And it really makes it pretty easy for you to take that thing down. So rule number 3 is in place. Rule number 1 is starting up. And rule number 2 is good. We're coming from a termination. Everything says down. Pull back to the area. And I guess the question is why did you get out so quick, right? So that's where the management comes in. That's the next step of it, is the management coming in. And just because dead horses make me smile. So Andy, here's a little lesson for you when you're thinking about whether or not it's time to jump ship, right? You jump ship on the same bar that got you in. You have every advantage at the entry. Yeah. See how your small triggers are way down here? That's pretty good. If you can sit tight, and let it do its thing, look at how the smalls are outside, or the bars are outside of the small triggers. There's no reason to even think about an exit until we start to get on the wrong side. But this one, you have such a great entry, keep your risk on. You never even waited for a reversal bar. But you had every advantage. Does that make sense? Oh, by the time you could think about managing it, filled both? What are your targets on the NASDAQ? Just curious. If you're in at 80, out at 86, that's $40, $80 on the first contract. And in at 89, 100 on the second, 10 and 20. So 10 and 20, Andy, and maybe this will help. When we talk about the NASDAQ, it's only $5 a pop per tick. When you're trading crude oil, when you're trading the ES, 10 and 20 makes sense. That's 100 and 200. And then a 12 tick stop makes sense. Because on those slower charts, it gives you room. No. My NASDAQ stop placement is 24. Because the NASDAQ moves, right? And you've seen it move, and you know how fast it moves. The NASDAQ needs a little extra room. But the cool thing is, Andy, is that the NASDAQ 24 ticks is only $120. It's the same monetary as that 12 ticks on crude. It's the same money, but NASDAQ just needs a little more room because remember, you're entering on a 13.2 chart, not a 5.1 chart. So you're entering on what is the large chart, for any other market that you'd be trading. Does that make sense? Cool. Yeah, and that's what those different stop limits are. Is the 12 tick stops are designed for your crude oil, designed for your S&P, your gold, your Russell. The 24 tick stops, those are going to be your ATM strategies to help out trading that NASDAQ. But everything about this trade is absolutely beautiful. I think you just had the wrong ATM strategy in there, which kept you from getting the most out of it. Great trade. And then Bob, is this the one we looked at? No, we didn't look at this one yet. Sure do like it though. Bob, it's perfect. Strong triggers, clear path, right back to resistance, easy money. Can I ask, Bob, did it feel effortless when it looked like that? Was it easy? Were you nervous? Were you confident? Man. And then it's just momentum for the win. And this is what I try to steer you guys towards is let it be easy in the beginning. You'll find a way to get into more difficult trades. You really will. Bob, absolutely picture perfect. You're 2 for 2 today, man. And I think that the biggest thing, the most important thing to recognize, let me see where we're at, is that, Bob, your easy wins came with momentum. Momentum led the way. Momentum is the reason it kept pushing, and all you did is just to find the perfect entry to ride with that momentum. When the momentum's down, sell high. And that's exactly what you did. All right, Gino. So large chart, once again, we're at that tail end of momentum, but we do have momentum. And then the one thing, and again, you put that you were taken out on one bar, which is true, you absolutely were. Gino, I feel like I'm going to piss you off today, but I'm not trying to. Momentum is slowing. And why am I putting momentum is slowing? That's okay. Momentum is slowing, and this is going to come into play. It's a 50-50 trade. So more often than not, it takes odds favorable momentum to break areas. If the triggers are weakened, or we'll just put weaker, the area is more likely to bounce or hold. And that's exactly what we ran into. The small triggers broke through. They were up against the large triggers. And everything still says down. But because there's this fight at 18,196, when you pull back and there's no areas inside of the correction point, it's still a good look, Gino. But because there's no areas inside of triggers, they're beyond, right? Or actually, that's right at the bottom of it. I like it. NASDAQ just pulls past. So let me go into a NASDAQ lesson, and I don't know if you've ever caught this in the room. When you get to the area on the NASDAQ, this is NASDAQ specific, brother, and these small triggers are less than a full bar away, you've got to wait. If you fight the small triggers, they're going to act as support, and that's exactly what probably happened there. But if you wait for the close on the correct side of the small triggers, your risk is already established, and you're able to take this trade down. And this is one of the things that you're going to see in the spreadsheet over and over. Small say wait. When the small triggers are super strong coming into the area, It's all right just to be a little patient. Wait for him to get to the other side. And I blew out about 10 accounts, Gino, learning this one. So when everything says go, when I get to my area, I've got to see where these are. This has been really my saving grace on the NASDAQ. I love your trade, dude. The trade looks good, but NASDAQ's got these little nuances that you don't tend to find on the other slower moving markets. NASDAQ is like that angry redhead that you dated in high school. And that little patience piece waiting to get on the correct side keeps me out of a lot of trades. It really does. It keeps me out of a lot of trades. And you can see it here. I took a short this morning where everything was beautiful. And I got in just below the mid band. And when I did, my small triggers were down here. And honestly, they just kept coming up and they ended up acting as support and it kept going up. So when those triggers are a full bar away, it creates a huge advantage getting in at the area. And when they're a little bit closer, it becomes a little difficult. So when the smalls are a full bar away, it makes it easy to get in. Your risk is defined and you've got room to correct. But when the smalls are really close and they're strong, it helps to be a little patient. And that's just one of those things that I figured out on the NASDAQ through a lot of heartache. Other than that, I mean, your trade is a nice one. Large chart said, had a good shot of going down. We just had this little area that wasn't broken yet, and it created a hitch in the market. It created that bounce. And that no divergence and those triggers outside, your small chart looked beautiful. Everything but the small triggers got you, and that's just that little NASDAQ patience piece. I like that trade. Hope that makes sense. If you go back and look at NASDAQ losers, I always encourage people, see if you fought the triggers. And then there's Ron's 50-50 up with momentum. Divergence kills the 50-50. So he's found a way to take that divergence, get on the right side of everything, and make a quick profit. Ron, that's a nice one. And then Dwight, let me break this down a little bit. Termination. I love not seeing a short, right? Weak triggers, you get the giant pushback all the way to the mid-band, resistance. There's your gap theory. Dwight, awesome patience. Awesome patience. And then when it turns the other way and breaks through the problems, you say, let me run that momentum all the way down to the fib. And what's cool is you have odds favorable on the large chart, Dwight, and the bars haven't gotten to the other side of the smalls on the small chart, which means you're still in that momentum phase. An absolutely beautiful trade. And yeah, Gino, take a few pictures. I literally, dude, probably 10 accounts I blew out. And when I went back and studied, and that's one of the reasons that, God, I say do this every morning. This is what saved my bacon. Is 10 accounts later, I didn't even follow my own plan. I went back and I started studying the charts, and that's the one thing that I noticed. I noticed that I kept trading into small triggers, and I kept losing going into the small triggers. So it just added a little patience to what I do. All right. Andy, strong momentum into a termination. You know what I was trying to do, but the NASDAQ moves so fast you can't get a grip on the mouse before the looks are gone, and this one got so lucky when it started to look for an entry. The area had broken. There was room by the time it filled. Had to pull it along. It was a termination condition. All right. Andy, it moves quick, doesn't it? And guys, this is one of the things. The NASDAQ screams. You really have to be on top of your game to trade the NASDAQ. I mean, you do. You really do. So, Andy, let's talk about it. Not even going to look at the small chart. Did you have odds favorable momentum or did you have slowing down? There's the difference between the two. One has separation and strength. One has the small triggers working their way back inside. Do you see the difference? And we just had this lesson. So this is just repetition creating recognition. Do you notice that this area absolutely got obliterated and this one held? There's a very distinct correlation between momentum and areas breaking. So Andy, when you have this look, that's not strong momentum, brother. That's the tail end of momentum. So that's strong momentum. Big difference between the two. So when I have the weak momentum and I have divergence, my charts are telling me, dude, it's just not likely to break. And then the second higher divergence you were at before, that one just kind of cemented it. So you're in on the wrong side. Rule number 3 is a little bit off. The momentum isn't there. And guys, this isn't me saying that you're doing it wrong. This is me saying you're creating an awesome opportunity to learn how to be more efficient in your chart reads. And it starts with, do you remember the picture that we took? Strong triggers, weak triggers. You begin to trust the reaction. You begin to believe that when they're not the strongest, and the small chart confirms it, that maybe it's not the best chance of success, that maybe that area is not going to break. And all it does is it gets you managing aggressively. And you were able to get in, get out, manage aggressively. Everything was cool. And that was that quick target. It saved your bacon here. But I'm not telling you guys that your trades are wrong. But there's certainly opportunities to do it better. There's certainly opportunities to be able to correct your chart read and say that this isn't strong momentum. This is a weakening. And because there's a weakening, perhaps I should make sure that it's perfect over here, because really, what's the likelihood? What's the likelihood of the area breaking? I think that's the picture. No, that's not it. The likelihood of it breaking goes down, guys. That's all I'm saying. Dun, dun, dun. Boy, termination for the win, right? Guys, that's the look that has the potential to break areas. That's the one right there. All right, Andy, I hope that made sense. GWC. And guys, if the NASDAQ appears to be moving too fast for you, it's okay to not trade the NASDAQ. It really is. Or make sure that you keep it on simulator, right? One of the biggest problems I had is when you're John Novak's little brother, everything smart that he does, he talks to you about. And then I try it. And then I get slaughtered. And when I've done it on Apex, it's just killed me. GWC. Termination. I can't see your entry on the small chart, but you're in at the HVA area. So termination, triggers roll, HVA line, down it goes. Guys, this is a trade called the high volume area trade. It relies on termination conditions. Man. Andy, I'm going to type a number in the room. That's how long Nexgen has been around. So by default, John Novak has been reading charts at least that long. But I can tell you that he had a client before he ever started Nexgen that taught him about Fibonacci and chart reads. I teach this class. I can't read a chart like John Novak. We see the same things. He sees it faster. It's pretty amazing. Guys, this is what we call a high volume area trade. And GWC did it perfectly. No triggers through termination, triggers roll, room to the target, in at the high volume area. GWC, I don't know if you're still listening, but you could not have done that trade any better. That is 100% textbook high volume area trade. And what it does is it gives you the opportunity to take advantage of tops or bottoms before the first trend trade. Nicely done. High volume area, Rob. High volume area. So when you add that next chart, this pink line is a line in the sand where the sellers said, hey, buyers, if you come back up here, I dare you. We're going to push with everything we have, but it has to be preceded with a termination condition. You learn about that in the high probability trend trade. You have to have your triggers rolling. You learn about triggers being in the direction of the trade in the high probability trend trade. You also have to have room to your target, which you learn about in the high probability trend trade. So this is just taking advantage of your chart reads and turning it into another trade. And this is a trade, that Nexgen has been teaching for years, and the rules are right here. And this is kind of the second thing. Okay, I'm starting to get good at reading my charts. I'm starting to recognize termination conditions. Man, I think it's time for me to look for another opportunity because the high probability trend trade has become easy. And the key is to not start looking for more trades until the high probability trend trade is easy. All right, Haji. You wanted the large chart to look good because of odds favorable momentum and a clear path, but then you notice price touching the mid-band, there was more than a bar away from the large triggers. So the gap theory, Haji, great read. The gap theory told Haji, don't take the long. He also said that his triggers were split. That's a lot of risk. So even though he had an entry, well, you didn't have an entry, you had an area inside of triggers, right? He avoided the trade because the large chart led the way. Haji, I'm going to steal your picture, man. This is beautiful. I'm going to go to patterns that repeat itself, and I'm going to drop this in here. And I'm going to call this, I want you to have credit, Haji Gap Theory Avoidance. Guys, when price reaches a midband and the large triggers are a full bar away, straight from the user guide, straight from the termination section, it's a termination condition, right? So even though Haji says, man, it sure looked good here, large chart led the way and kept him out. And what's awesome, Haji, is that you didn't lose $200 or $300, right? You didn't have to go through the frustration. You didn't have to go, oh crap, I don't know why. You just simply said, here's my chart read, my rules aren't met, I'm not doing anything. It's the hardest thing you'll ever do, guys. The hardest thing you will ever do is absolutely nothing, even though you're dying to take that trade because it looks like it might be pretty good. Great read, great job. And then Andy, odds favorable. Everything's screaming, sure looks good. Man, look at how fast those small triggers are coming down, Andy. So you remember that talk that we just had with Gino, brother? Don't fight those small triggers. And then Andy, one thing about NASDAQ, these pink 1-to-1s, on the NASDAQ, remember guys, the rules we talk about are crude oil, S&P. On the NASDAQ, those pink dots can kill a trend. So you're a 50-50 trade with divergence. News coming up at 11. Thank you, Adriana. What's coming up at 11? I had no news on my calendar. But Andy, just as you work through the nuance of the NASDAQ, the pink 1-to-1s can be problematic. Today is Monday, right? Can someone show me your calendar? Do you guys have every country known to man in there, maybe? Nope, I still don't have it. Even if I put every country's news on there. What do you guys have that I don't have? Will you show me a picture of yours, Adriana? Maybe you're using a different news source. You have a different news source? Okay. That makes sense then. Look at the termination for the win, guys. Look at how far the market went up. Look at how it broke resistance and came back to support. So Andy, I think this was your trade, wasn't it? Is that the one that you just took? No, that's a different one. Investing.com. Right on. Cool. Does it label them out? High impact, low impact? It does? Right on. Cool. Oh, impact, 2 stars. I got it. You only have the high ones? Right on. Very cool. Thank you for sharing that. 3 stars only. Andy, did you catch the lesson on the triggers? You guys that are trading the NASDAQ and getting run over on what looks like a great trend trade, are you beginning to recognize? Go study that, guys, I'm telling you. It's going to pay huge dividends for you long run. All right, Miss Jen, let's see what you did today. Strong triggers. Great bottom. Everything says up. Support. You take the, let's see, termination, strong triggers, pull back to support. It's still a little, and this is a great one right here. And you held it all the way up to resistance. So Miss Jen, the only thing that I want to show, that I want to point out to you, is at the time of your entry, your large triggers were still down a little bit. Do you see that? Not a deal breaker. So the termination is beautiful. Your small triggers are screaming. They're on the right side of everything. And the large triggers just take a little time to roll. You pulled back to support. And what you're going to get a lot of the times when the small triggers on the large chart have already confirmed, yeah, that termination's good. Look at us go. It still may close down to these triggers. So great stop placement. See how your large and your synthetics are different colors? Just a little bit of indecision. So when you have that little bit of indecision, if you get in at the mid band, you've got to be prepared to hold just a little bit. But you had every indication that this market was going up. Perfect termination, strong small triggers, 3 divergences in the same price range, large triggers, no divergence, odds favorable, I mean everything. And it just pulls back to the synthetics a little bit because it takes them a minute to get that roll. Beautiful trade. Very nicely done. And great patience. Great patience waiting on that thing to roll. And then CAV. Everything says up. Life is good. Market is strong here. Market is weakening here. That's okay though. 1 divergence and strong triggers, you take it, and there's that look again, guys. When the triggers are separated, see how it comes back to the synthetic? CAV says, hey, I'm losing momentum. I've got a loss of momentum. It's probably going to go a little deeper. I don't have an area in the correction point, so let me go back to the furthest point of the correction, and I'll get in there and have low risk. And CAV, that is absolutely beautiful execution. But there's that look again, a little loss of momentum, and it just pulls back. It pulls back a little deeper with that loss of momentum. Doesn't mean that it's over. It just means that it's not perfect. It might go a little deeper. Nicely done. And then Miss Jen again, that is definitely a strong top. And you definitely have odds favorable momentum. I'm not following your entry logic. Pullback sell limit order below 1-to-1s. Did you get in over here, Jen? Because there's your pullback. So you got in on the way up. And then once again, we see it go to the synthetics. That's twice now that we see it go to those large triggers that haven't rolled yet. Do you see the pattern? Oh, this is kind of cool that you took the exact same trade. So if you had a limit order below the 1-to-1s, it would have just put you in. So you let it come up and then come back down, and when it cleared the 1-to-1s, you entered the trade. Is that right? Okay. So you said, I'm not sure. Let me get to the other side of trouble with all that momentum, and then I'll take it down. Little hitch, doesn't phase you, and then out at support. I love it. And I like this entry too. And notice how this is the NASDAQ, and the NASDAQ pulls up. You're on the wrong side, the momentum phase. And once you get to the other side, it's pretty freaking easy when the large chart looks like this. Nice job, Jen. Great patience waiting for that one. And then Haji, my mission is to never miss one of your charts again. And I'm doing all right so far. All right, not a good bottom. So what does he mean when he says not a good bottom? He means that it's not a termination condition that reverses the market. It's just kind of coming from the middle of nowhere. Weak triggers, and it pushes up, and the smalls are above, and the large are not. So this area has the potential to break, but it's not broken. And there's no divergence on a 50-50. You get in at the high point, stops in the right spot, and you get paid. And then Haji, this is perfect execution on a 50-50 trade. Don't have a clear path, so you didn't sacrifice momentum. You get in at the area, and sure enough, you're able to get paid. Really nicely done, Haji. That fits the KISS plan. Cav, strong triggers up, directly into a termination. Small stayed above the large on the pullback. Took the trade inside the synthetic trigger with the mid band, got in a little early, took the trade due to the small triggers on the 34.5, reached both targets. And then, Cav, are you with me in here? And then this is also for Gino and Andy and anybody else trading the NASDAQ. Strong small triggers. Your first close on the correct side gives you a better entry with established risk, especially trading directly into a termination condition. Does that make sense, everybody that trades the NASDAQ? That little piece of patience, wait for the close on the correct side of the small. They're absolutely screaming against you, and you're trading directly into a termination, and you've also got divergence on the small chart into 1-to-1s. That's about one of the worst termination conditions you could trade into. And it's also a 50-50. At least there, waiting for the right one. If all of those problems create a bigger push down, it keeps you from just getting run over and stopped out way down here. Does that make sense? See how the small triggers behaved as resistance right there? And I'll share this with you guys every time I see a NASDAQ trade that does it. You'll begin to recognize just how often it happens. And then, of course, Cav, look at that just termination condition, which makes it easier to take this trade, that little bit of patience. I wanted to point out that it's coming from a beautiful bottom. Nicely done. And I think that's just the news stuff. And then Grant, let's see what you did. Glad you got your charts back. Large chart was showing small triggers below large triggers on a red background, clear path except for midband. One of my favorite words. Clear path, except. My rules were met, except they weren't. Does that make sense, Grant? This is another one of the reasons that annotating charts, guys, pays huge dividends. And what you're going to find is that there are keywords in your annotation. That give you an idea on whether or not, even subconsciously, you're breaking your rules. And then Grant, because we hit the mid band, if the large triggers were lower, it wouldn't have been problematic. But because they're a full bar away, because those large triggers are a full bar away, they're behaving as a termination condition, which means that this is more likely to put up. The one-to-ones don't have any bearing on it. You place stop loss at the mid band. You entered a sell order just below the mid band. So did this one stop you out? Did it come up and close the gap? Yeah. Let me go to my crude oil chart. That was it right there, I believe. See that gap theory? This is a great lesson, guys. When you hit that mid band and the large triggers are a full bar away, it just keeps you from taking that trade. Notice that it did bounce off of them. And you see that a lot. And I think this is great recognition. I think Haji posted one earlier. The same idea. There's the mid band, large triggers, full bar away. Just don't go long yet. Mid band, large triggers a full bar away. The long doesn't work. Mid band, large triggers a full bar away. The shorts don't work. Does everybody see the pattern? It's really pretty cool because it happens a lot. Got up above the mid band a little bit, but the large triggers were a full bar away and the long doesn't work. Short doesn't work. And it's not saying go the other direction. It's just saying that the first short is a little bit too soon. So Grant, pretty good look on the chart. Pretty good look on that chart. The momentum was there, just the path wasn't clear. And that happens sometimes, right? But you got to take these trades to know how to not take them next time. So guys, that is all your pictures. There's 3 divergences in the same price range with the triggers pointing down. If you had to take a guess, would you suggest that this might be going lower or higher? And then Grant, let's compound on your great lesson, man. So now I'm into the mid band, but my large triggers are not a full bar away. My small triggers are through the area, but my large triggers are not. So I'm still 50-50. And I don't have any areas inside of favorable large triggers. So if you're the high probability trend trader, you're hoping this market pushes down a little bit. You're hoping that it gives you that momentum, and you're hoping that your areas catch up with triggers, because right now you just don't have them. So there's really not a lot to do for the high probability trend trader. Directly into a divergence low. Rules not met for the short. Smalls didn't even get through the area. And sometimes the market's going to try and convince you to break your rules and say, hey, it's always okay to break your rules. Look what just happened this one time. Look what happened this one time. You should break your rules every time. That's what the little devil on your shoulder tells you. So you start going long into this, and you start going short into this. Do you see how this look is this look? You start going short into that termination, and you start hoping that this one breaks. And guys, consistency is key. So I'll let you guys watch. We'll see what that one does. I don't know what it's going to do. I can't tell the future. But I'm going to take 5 minutes. When I come back, what we're going to do is answer questions that you guys want. Guys, we're going to go through your lessons. So I'll see you in about 5 minutes or so. All right, guys, let's finish strong today and see where we're at. So far, the termination condition's still holding. It doesn't mean that it's going to hold forever. That's the thing. Is areas break all the time, guys. The market pushes up, the market pushes down, the market does all these different things. The idea with what we do is to have an advantage every time we take a trade, to have some sort of set of rules that defines that the look is more likely to win than it is to lose. And then Cav coming from a good bottom, there's that termination. Coming from a good bottom sure does pay dividends, doesn't it? And then you get the momentum. And guys, I want you to see this, because what this is really beautiful use of the gap theory. Is Cav doesn't go long up here. Cav lets it pull back to the synthetics, all the way back down here to the 1-to-1s right at those synthetics. Cav fighting the small triggers again. Close on the correct side is almost the same entry. Less risk into the termination. But great patience. Letting everything roll, coming off that termination condition. And guys, this is about the 4th or 5th time that we've seen the small triggers create problems until you get to the correct side. Just a great pattern for you guys to recognize. It's the trigger lines, Grant. Price reaches the area. That's the bars. And then it's the trigger line location that's going to help us define whether or not the area is broken. So does that make sense, Grant? And then Gary. So 1-to-1s, Gary, are 100% Fibonacci alternates, and they print in the moment. So they'll start printing, and then when the rules are met for them to be broken, see how the trigger lines get above, all that good stuff. They stop printing. They're in the rearview mirror. They're done. They're gone. This fib was some sort of update that didn't hold true. Actually, it was from a 5-1 chart that started to come up, and maybe the calculations recalculated over there, then eventually it comes back into play. So Gary, when we're talking about termination conditions, we're looking at the now. We're really looking at the most current bar. So you see how these 1-to-1s printed when the rules for the 1-to-1 printing happened, but they're done. They're done printing. And that was the entire life cycle of the 1-to-1 there. And this was the entire life cycle of the 1-to-1s here. And you can see that they used them in both cases. And then if you scroll back, the same is true for divergence lines. Once the rules are met for it to no longer be true, it'll stop printing. Sometimes it holds longer. Sometimes it's a little shorter. And then let's find a 10 a.m. At 10 a.m., we get fib updates, and I'm looking to see if there were any. So sometimes you'll see fibs. There you go, 9:59. See how they stop and recalculate? So every 2 hours, your software will recalculate as well. So depending on what time frame you're in or what time zone you're in, let me look at your picture and see if we're... So that wasn't your picture. Let me open your picture again real quick. I want to see what the timestamp was. Nope, that was 9, but that was your 8 a.m. That was your 8 a.m. fib update, Gary. That does make sense? Cool. I had to go down and look at the timestamp, and you'll see that at 8 a.m., that's right when that one happened. That was your recalculation. Good stuff. And these are great lessons. And then just to compound on it, if I could, when you're looking at your large chart, guys, I've got this picture that says, what are the fibs? You'll notice that there's skinny ones that don't print all the way. There's fat ones that don't print all the way. And then there's skinny ones that make it all the way into eternity. What you're going to find is that the skinny ones that don't go all the way to the right Those are from the smaller time frame. So if it's S&P, crude oil, Russell, gold, those are from a 5-1. If it's the NASDAQ, those are from a 13-2. This is all on your large chart. So the fat one here is from a 21-3, or if it's the NASDAQ, it's from a 55. And then the ones that print all the way, that's native to it. But you'll notice that the ones that are synthetic, that are from a different time frame, they appear to be a bar behind. And what happens is when this bar prints, then it'll carry over. But if it stops printing in the rear view mirror, it's done. So in this case, Gary, these 1-to-1s are still in play. They look like they stopped printing, but 1-to-1s will print another dot. They're always lagging 1 bar behind. So if the market pulled down real quick, you wouldn't have a clear path through that little shot. Does that make sense? And thank you to Cav for that lesson. He pointed that out one day. I never noticed it. But it'll always be a lag behind just a little bit. Then Andy, learn something new every day. The 1-to-1 done printing, trying to wake up, pay attention. You're doing great. And then regarding divergence on the 5-1, if you're looking at a short trade and the divergence is above entry, or looking for a long and divergence is below entry, is it significant? Can you show me a picture, Haji? What market were you looking at when you thought about this? So what trade are you looking for? Long or short? And this is only one chart, so it doesn't help. Okay. What did your large chart look like? Show me both charts. I know I'm a pain in the butt, right? So you're looking for a short trade. Does this divergence mean anything, or does this divergence mean anything? Because clearly it's a 50-50 at best. Is that right? Can you show me both charts? Because they'll play in differently depending on what's going on. Yeah, no worries. No worries at all. So let's do this, right? 50-50 on the fib. This divergence very much creates problems because it's a 50-50 and it may push up a little more. 2 divergences is even more problematic because we're losing momentum more. 3 divergences in the same price range on the large chart's problematic. The NASDAQ's really in a consolidation mode. But so far, it's terminations for the win. And divergences are confirming it. And that's crude oil. I just want to make sure I'm looking in the right spots. So let me pull your chart back up. And we'll just talk about what we see here. If it's a 50-50, that divergence for most of you means no short trade. A second higher divergence, if you are in the short trade, becomes a management opportunity. Second lower divergence says maybe exit, take profits, and if you get another signal, you can try it again if the rules are met. And then if we get the third divergence over here, well, then that's the termination condition. So it's it depends on what's happening on the large chart to see where I'm going to feel. What about the 10% that is, okay, this one right here? All that means is that when the buyers tried to fight at the first bounce, the sellers told them to go to hell. That's it. It's nothing more than one loss of momentum on the little push up. The buyer said, hey, here we go. And the seller said, yeah, no, you're not. No, it wouldn't have any bearing whatsoever on it. Because you're going to see these little fights, these little fluctuations all the time. So what happened at that right there is, let me pull this up real quick. Go to the glossary of common terms and click on divergence. There was just a little calculation. So on this little push up, your MACBBs didn't follow on a small chart, which means that the momentum is just losing a little bit. That's all it is. It's just one loss of momentum on a small chart. Not a signal for a short. Absolutely not a signal for a short. And let me go back to the rules on the 50-50. I try to do clarity. So let's do clarity here. Is the divergence that we look for in a 50-50 is the one into the trade, right? Because this pivot does not have a loss of momentum. Maybe you go short right there at the area inside of the triggers because it's a 50-50, because there's no divergence. So it is not any divergence, but if the divergence gets in the way of the profit, I see what you're saying. Well, it's maybe not even in the way of profit. Maybe it's a 50-50. So what does a 50-50 mean? A 50-50 means the area is not broken, right? And what does it take to break an area? Momentum. You following me? So it's not that the first divergence is in the way of profit. The first divergence says that momentum is decreasing, but you see it first on the smaller, faster chart. So if it takes momentum to break areas, this is your first indication that momentum may be leaving the scene there. So this doesn't even get in the way of profits. This says, hey, guess what? Those areas you're hoping to break, we may not have the giddy up to break them. And then if you take the trade anyway, and there's situations where you will, there's your second indication that the momentum is decreasing even further. So what it does, Haji, is these divergences say, all right, we're getting less and less likely to break the area. And then you get a pivot stop out, and notice how the triggers are up and stuff like that. And if divergence prints again, that's that third divergence saying, yeah, it's just probably not going to happen. Does that make sense? And then let me see if I can find one of the things. Obviously into a termination condition. I love the divergence talks. One of the expectations of divergence when it prints, so Haji, if you said, I like this look, I'm going to take this long trade, I feel good about this long trade, everything except that one fib says we're likely to go, I got a great entry, and this divergence prints. Here's what that divergence tells me. Is I've got a pretty good shot with this momentum of taking out this pivot. Which means that when I get up and I take out this pivot, whoops, wrong one. When I get up here and I take out this pivot, well then that divergence has done everything that I expect it to do. Does that make sense? And it pushes me right up to the fib that I hadn't quite reached. So in this case, it helps, but the problem is you don't see it until about right there. So you have to feel good about the trade going into it. And then on that same token, you didn't see this divergence until all the way down here. So it wouldn't have any indication really that it was being helpful at all. But notice that it took out that pivot before the trouble happened. So you can start creating these expectations with divergence, saying, let me see if I can find a good example of it. Boom, boom, boom. If you were thinking that you were going to go short off the mid-band and there was a divergence, the expectation would be that it probably takes out this pivot, and it did. And then the termination condition wins. The expectation of this divergence would probably be to take out this pivot, and it did. And then the termination condition wins. And it's kind of cool because that's a little more advanced, but you'll begin to recognize these things in the moment. But remember that divergence doesn't print until the third bar. So right now, I have the potential for divergence. It's not doing anything for me at all. And it may print or it may not, but I won't know if it's going to print or not, Haji, until about right there. And I don't know if it's going to give us a lesson, but this is why we don't trade the potential divergence, and this is why it's so hard to rely on what you would think is a helper divergence. But if you were in this trade and it was already up here and divergence prints, you might say, okay, here's the expectation. So if divergence prints here, the expectation would be to take out this pivot. And look how that's on the wrong side of everything. And we'll see if that happens. We'll come back to it and look at it. That's an awesome question. And then here is the Russell. Odds favorable. Here's the best lesson ever for you guys. All right, who's new in here? Jen, this is important for you. Who else is kind of new in here? Rob, this is important for you. You guys that are new. Did we have momentum? What do you guys think? I love this look. We can say that we had odds favorable momentum. Smalls below the large, everything down, looks great. Oh, we did. There's even separation between the two. Remember that this printed up a bar after. So it really looked more like that, Jen. How do you like that? Small below the large? Cool. Remember, this is a couple bars late. And we also had a clear path. It didn't reach the area. I think rules 1 and 2 are met beautifully on this chart. Does that make sense to those of you that are going through the method here? We did have momentum. And we did have a clear path, which means 66% of our advantages are rock freaking solid. I had areas inside of favorable large triggers. My rules say don't miss this short trade. Does that make sense to everybody? Guys, this is so important as you learn the software. My stop would have been somewhere right about here, and it would have been hit, and I would have taken a loss, and I would have lost money. But I had the advantage of momentum. I had the advantage of a clear path. I've got drunk fingers. I had the advantage of an entry area. I had everything that I needed for a high probability trend trade. And anything that wins 70 to 80% of the time has to lose 20 to 30%, guys, and this is a cost of doing business. But if you take the time on your losers to define the momentum, to define the path, to define the area inside of favorable large triggers, what you can say to yourself is, man, this one didn't work. And guys, look at this. It even had no divergence and strong triggers. Everything. This is the best of the best of the best look. And it didn't work. It just didn't work. And I want you guys to start being okay with that. I want you guys to start being okay with the idea that they're not all going to work. I want you to just say to yourself, I had every advantage. This is the sexiest looking trade I could ever take. But it's a cost of doing business. And what it does is it keeps you from start second guessing and wandering and being dejected and angry and going, oh, what am I doing wrong? Because the reality is if you took that trade, you did it freaking perfect. And it just didn't work. Everything about that trade was rock solid. It just didn't want to go. We're not in control. 2 divergences. This may have been the same thing. That's the NASDAQ. Areas outside, small triggers, close below. Second divergence lets you take an exit if need be. And that's the second half, guys, is getting into the market at the right spot is great. Being able to manage it is even better. So I'm going to pull this back up, and we're going to talk about a little bit of management because nobody's posting and we still have a little bit of time. So using those pivots for stop placement pays huge dividends, guys. If it doesn't give you one, then you're going to take a loss. Here you take a smaller loss. And then Haji, this kind of goes back into the divergence thing. Here's some management tips for you guys, some management ideas. And I'm going to go ahead and drop my slideshow in the room, guys. These start right around the 27th picture for you guys that want to look at them. If I'm in a long trade and a second divergence prints, lower divergence prints, I'm going to exit the trade when it happens because a second lower divergence can push the market down further. If the large chart still says go, I can re-enter with a reversal bar or some sort of signal up. But a lot of the times this is a deal breaker, so I'll exit, I'll preserve my equity, and I'll wait for another signal to get into that trade. That's one of the ways you're going to be able to use divergence to help you manage your trades. If you're in the short trade, one divergence doesn't freak you out. It might even get you into the trade. The second higher divergence says, let's exit the trade. Let's get to break even. Let's not lose money. And then if you never get a signal, well, then you never re-enter the trade. You never end up taking a second loss. You don't get married to the idea that market needs to do what you want it to do. Does that make sense, everybody? So one of your management tools as you grow with the software is to be able to recognize a second higher divergence. It creates problems. Another thing that you'll see is when you get up to yellow 1-to-1s on a small chart, it's okay to cut strings, to take half your profits when you start holding for these bigger moves. If divergence is true, get the hell out. And that's why there was a trade earlier that went directly into a termination condition, directly into a 1-to-1 with divergence. And it's such a problematic look, and it's going to mess up your day more often than it doesn't. So understanding these and getting to the point and going back and studying them, circling them, you'll begin to see it. And if divergence is true after the second down bar, you can re-enter on another signal. It doesn't kill it forever, but it says, let's wait for it to be perfect again. Let's wait for a signal again. And if you never get it, then you never take that revenge trade, right? That next trade. Short signal's beautiful. Guys, if you hit an area and divergence is true, that's an exit condition, which at the same time means that's a not entry condition. So when you begin to recognize when it's time to get out of a trade, you should also know where it's not cool to get back in. And then if you get in long and you have that divergence high, take half off. And then if it gives you another signal, put it back on, right? But this is all predicated on the large chart being true. So all of these are in the PowerPoint that I just dropped in the room, guys. Management's the second half of everything. The entries become pretty easy. The management is where things happen. So I've gone from odds favorable to a little weak, but I do have a clear path, but I don't have an area inside of favorable large triggers. I'm missing 2 out of 3 of my rules. Should I arbitrarily enter or should I wait for a signal, guys? That'll be up to you. All right, termination creates the reversal. Did it break the area, Andy? Let's go through language. All right, Andy, you put that it broke the area. So I'm going to pull this picture up real quick. And I'm going to take a picture of yours. And this is kind of a cool little thing that I've never done before. And then I'm going to take a picture of mine, and you're right, you already answered, but this is a good one. Guys, if you need to go back and police yourself a little bit, what do you think? It wasn't a termination condition because the small triggers were through. And it wasn't a clear path because the large triggers weren't through, which means, Andy, you're in the 50-50. And you just put that, right? So understanding what you're up against, what does that do? That changes your management, doesn't it? Because if you say you broke the area, these divergences, you couldn't care less. But because it's 50-50, one divergence is problematic. Two divergences, especially a lower divergence, is super problematic. And you just have to be a little patient. So second divergence before the area met, sure did close out of this one. Beautiful. Did you enter it or did you just cancel your trade because of the two divergences? Because either one is brilliant, right? Either one is a great chart read in the moment. Either one is saying that my money is more important than my hope. Cancel before filled. Perfect. And then there's the NASDAQ. So that was it, right? And guys, this is, I think, an important part of it. Andy, how freaking smart were you feeling after you canceled it? How smart were you feeling? Pretty nice, right? You're like, hey, wait a minute. Rules for the win. And then the market screams all the way down and the large triggers don't follow, which means even if you wanted the short, all right, guys, I need you to let me know if you're getting this one. Even if you wanted the short, the small triggers said don't do it. We've talked about this lesson quite a bit today, guys. I'm going to keep going after it for my NASDAQ traders. We've talked all day long about not fighting the small triggers on the large chart or on the small chart. So your small triggers keep you out of the losing short. Your rules keep you out of the losing long. And then Miss Jen says, wait a minute, I've seen this before with the strength and everything rolling. That might be a long trade. From a bad top, doesn't finish, goes off to the next area. Well, that's a pattern that I recognize. And that's all we're doing, guys, is just let's recognize patterns and let's learn how to take advantage. 50-50, two divergences says don't do it. Three divergences says come on, don't do it. So now you have to wait for everything to roll around to give you the advantage again. Guys, we got about 10 minutes. What would you like to talk about? Notice how the small triggers were a full bar away and it gave you time to manage back to them if you decided to get in at the area. There's the other half of that NASDAQ rule, guys, or that NASDAQ observation. Is when they're strong against you, doesn't work out. When they're still a full bar away and everything is good, definitely gives an advantage. I think I'm out of smart stuff. Awesome. Cav, have a good one, man. Have a good one. We'll see you tomorrow. All right, y'all. This is where I flap my gums. So bad top triggers roll. So Rob, you're asking. Let me make sure that I'm getting the question right. If you have a bad top and everything rolls, yeah, I'm expecting them to continue up, and you'll see it a lot. Not a no triggers through termination, right to the mid band, and they try to push down, and it doesn't happen all the time. But there's your bad top, back to the mid band, up to the next key area, right? There's your bad top off of the termination, and they push all the way back down and can't get through the termination, and then they go to the key area, and the buyers give up. And it looks different all the time. So there's your termination that reversed it. Bad bottom, 50-50 doesn't work. Off the pink 1-to-1s, gap theory pushes down. Back to the 1-to-1s that don't break, back down. Nice, you made 130. I like it. So you start to recognize these patterns. And just because you recognize a pattern, you're ready to go on sim. Good. I love it. You're taking trades now on sim. So now the next step is to post all those in the room. Because to minimize your learning curve, post pictures of your trades in class. Every trade, win, lose, or draw. And if you win and the rules are wrong, you may have a short-term victory, but a long-term failure. How will you know the difference? To be sure, you need feedback from us. We're here to help. If you place a trade on the simulator, if you participate in class, there's no risk of loss or capital. You need someone to tell you what you did right or wrong when new. And this is part of the magic, guys. This is what we do. So, Rob, do you think taking those pictures over and over of odds favorable momentum and pullbacks, did it make it easier to catch the trade live, do you think? For some people it does. It really does. But it's a pain in the ass, isn't it? It feels that way. It's amazing how much we don't like doing work. The hardest working people I know can come to learn to trade, and they just hate to do the work. So now I have anything can happen triggers. Now I have divergence and anything can happen triggers. Now I'm below my correction point. Now my small triggers aren't a full bar away. How many disadvantages can I talk about? No internet today, definitely looking at Starlink. I've thought about Starlink. I think it'd be fun to go work like in the middle of a field somewhere, getting chased by grizzly bears. What do you want to talk about, ladies and gentlemen? Miss Jen, how you feeling? In Central Illinois. A lot of my wife's family is from Collinsville. I think it's a little further south, but it's a lot of country. Yeah, we did change our times. Americans are ridiculous. Hey, let's do arbitrary shit that makes no difference on anything. That's the American way. Champagne? Okay. Bob L., you feeling a little better lately? Trading with that momentum, working those pullbacks. A lot of NASDAQ lessons, guys. Remember that the NASDAQ's a little different animal. Good. And now it's just being patient. That's the part I can't help with. You guys know that, right? You can have the best software in the world, right? You can have the best plan in the world. The only thing that Nexgen can't give you guys is experience, is to give you the repetitions for it to become easy, to give you the repetitions for things to become clear in a moment. And that's the struggle for most people, is we want to be busy. Most people would rather be busy than correct. And that's weird, right? I know that my rules are wrong, but I really want to be in a trade. I know that I don't have these advantages, but I hope it goes up. And that's where that annotation comes in. Yeah, Gary, Saturday night, 2 a.m., we went ahead an hour. I love it, though. That means I can play golf later now. But it's one of those things where like you can look at the chart and you can say to yourself, it's a 50-50 on a divergence high, but the momentum is great, right? And all it says is I gotta understand what I'm up against, because now I know that the path isn't clear. I don't have the best triggers, and I don't have an area inside of favorable large triggers, and my small triggers are down strong. So if I go long at the mid band, it's not fair for me to expect this one to win because I know I'm giving away the advantages. Here you are learning patience. The reality is I can't control the market, guys. I don't make it go up. I don't make it go down. They don't care if I want to win or if I want to lose. The market doesn't give two craps about me. I am the smallest of small fish, guys. I'm a barnacle on a whale's butt. You know, they don't even need to be favorable. You just can't trade into them. See how they worked as resistance? See how they just did it again? The rules aren't met, but if you were just going to jump in, it saved your bacon. Divergence, not from an area, likelihood is to go down to the mid-band. And these said don't try the long. And it's kind of cool because you'll start seeing your rules being met, Jen, and you'll be like, oh my gosh, my indicators just told me don't go yet. Man, my indicators said be a little patient. My indicators told me just relax for a minute. Life can be good. It's not your money yet. So just give it a second. Most of the people that I know who are successful don't take a lot of trades every day. They take the best trades. And when they post in the room, all their trades look the same. You guys will notice that Ron, I don't think he's in here for me to put him on the spot, but Ron posts 2 trades. Ron has 2 trades that he takes. That's it. You won't see him post anything else. Cav has gotten to the point where he has 1 or 2 trades that he takes. And the people that are successful, these are the people that aren't trying to do more, they're trying to do better. And I know. I have bad days when I break my rules. I have great days when I follow my rules. But the truth is, I still have losing days when I follow my rules because I can't win all the time, and sometimes it just doesn't work. Sometimes the trades don't work. Sometimes I have every advantage, and it just doesn't work out. So you just got to kind of do what you do, guys. Every time you trade, you're talking about advantages. Every time you're talking about advantages, you're really selling it to yourself. That this is probably going to win more than it loses. That this little setup right here, if I take it 100 times, I'm going to lose 20 to 30 of them. And I'm okay losing 20 to 30 of them because I'm going to win 70 to 80. And when I win 70 to 80 of them, well, shoot, life is good. So, guys, that's it for me.